Good morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith, and here are three things you need to know this morning. Major chip makers Nvidia and AMD slumping in pre-market trading after a Wall Street Journal report suggests fresh curbs on sales to China are on the way. The original measures were announced by the Biden administration last October and meant only certain chips could be sold to China-based companies and only with a specific license. Any further restrictions would be a big blow to Nvidia, which gets around a fifth of its revenue from China. It's been the biggest beneficiary of this year's AI craze. AI stocks listed in the nation also seeing steep declines this morning, including Inspur, the world's second largest AI server manufacturer. Fed Chair Jay Powell is going to steal the focus again this morning as he joins a central banker power panel in Sintra, Portugal. The discussion forms part of the ECB's Forum on Central Banking. He'll be joined by European Central Bank President Christine Lagarde, Bank of England Governor Andrew Bailey, and the Bank of Japan's Kazuo Ueda. Powell will be watched with laser focus for any signs of increased hawkishness after outlining that more rate hikes are on the way. The same is true of the ECB's president, who's made it clear the central bank is not done with its hiking cycle either. And it's the economy, stupid. President Biden will extol the virtues of his so-called Bidenomics economic platform in a speech in Chicago today. It's being labeled as an opportunity for the president to persuade undecided voters that the U.S. is thriving under his watch. The theory of Bidenomics is that it's essential to grow the economy from, quote, the middle out and the bottom up. This has been a regular refrain of Biden himself. Fresh data from polling analysis website 538 shows Biden's net approval rating, though, slumping by nearly 4 points during the first half of the year.
Well, the U.S. is considering new restrictions on AI chip shipments to China, according to a report from the Wall Street Journal. This as concerns mount over the possible threat of an advanced AI in the hands of U.S. rivals. Shipments to China from chip makers like Nvidia could be blocked by the Commerce Department as early as next month. Chipmaker shares falling pre-market on the report. An earlier string of actions and sanctions in October, they blocked certain advanced chip shipments to China from the U.S. manufacturers. Nvidia and AMD, they skirted those restrictions with downgraded versions of their chips that fell under sanction thresholds. The block also spurred heavy Chinese investment in domestic chip manufacturing as well. And so there we were taking a look at some of the chip makers. Of course, it's important to remember that there are two parts of this broader process. There is the design that takes place, and then there's also the fabrication. But for any of the fully completed, they're also looking at where those shipments might actually take place on fully completed chips into the hands of other actors or other nation states around the world as well.
Right. And some of the analyst commentary this morning, even for the likes of Nvidia, has been that even if the company gets a fifth of its revenue from China, that this won't necessarily shrink that to nothing, right? That it will affect perhaps some of its chips there. But I think the bigger question is whether this is one thing or the thing that might slow down or break the AI rally. Yeah. I don't know about that. So let's bring in our panel for this morning. Callie Cox, eToro USA investment analyst, and Matt Maley, Miller Tabak equity strategist. Callie, let's start with you here on this China news, right? It's sort of, it is just a report for now. We should caution. We don't know what's actually going to happen. It's definitely affecting these chip makers in pre-market trading. How seriously should investors be taking this?
Well, Julie, I think this is where the rubber meets the road, and I think AI is a great story. I think it's hard to argue against the fact that it could change the world, but these bumps happen when we're talking about new technologies, and this is a very new trend. And of course, the market is reacting to it because, it's been hype for most of the first half of this year. So I would tell investors that, this is kind of part of the process. This is the world figuring out where AI fits, and there are going to be ups and downs.
Is this the first in the AI FOMO trade, if you will, Matt?
Yeah, I do think that this group has had an unbelievable run, and whether it be the AI stocks in general or the chip stocks in particular as well. I mean, you look at obviously Nvidia is up 40% in just less than a month, and almost 300% since last October. So on a technical side of things, it's getting very extended, also very expensive. So it'll be interesting, not only this week, but as we move into next week, when we're after, in other words, we get past past the beginning of the second quarter, and a lot of these institutions, they want these really high flying stocks on their on their balance sheets as they have, or within their portfolio, but they might start to pull back a little bit because of this concern. I mean, this is I guess my point is that this news is coming at a time when the stocks are overbought and expensive, and it could be a reason for short-term traders to take some profits and longer-term traders to pull back and wait for maybe lower levels to add to their positions.
It does feel like more broadly, Callie, that investors have sort of shrugged off geopolitical tension risk between the U.S. and China. I mean, yes, you get some flare-ups like this in some instances, but it doesn't seem like, by and large, investors are that worried about it. Do they need to be watching it more closely, or is it okay to sort of pay attention on the margins? Yeah,
well, it's always important to pay attention to the world around you. I think we can all agree on that. Headlines like this do pop up. Some of them matter a lot, 90% of them don't. I'm not sure how much investors will put stock into this headline, certainly today, but for the days following, I'm not totally sure. But right now, with the momentum we're seeing in the US, with the excitement that we're seeing from consumers and increased confidence, we could be at a point where they ignore it. And who knows? This is just a report. We don't have the facts in our hands.
Well, one of the continued questions that I have, Callie, is just the fact that we don't know how much these companies are even spending right now on the research, the development, the advancement of bringing some of the solutions to market. So even with the absence of that, it's still not certain what type of margin profile we could even expect from these companies when they do bring it to the market and to their customer base as well.
Right, and this is the key of the AI story as well, because we talk about how AI could change the world. Again, I certainly believe that AI has the possibility to change the world, but we say that about a bunch of technology, and really we haven't seen this uptick in productivity and company excitement for a piece of tech since the early days of the internet. So the bar is really high, and if we see companies start spending on it to increase that productivity, and they put some serious cash behind it, which I think there's a possibility that could happen, then that's where AI really makes me excited. But it'll take a while to see that.
Yeah, Matt, it's funny, to Callie's point, like the stuff that has changed the world. I mean, you could argue the smartphone has done a lot to change the world. I don't know that there was that realization, right, when it was coming out, how much it would change things. So I think, or do you think, that it sort of makes it difficult as an investable case here when it's difficult to predict?
It does, and Julie, one of the things that we have, of course, is that we remember what happened with the internet, and it certainly did change the world. We saw how Amazon changed the world, and yet Amazon, because it got so incredibly expensive and ahead of itself, it still got absolutely clobbered when the dot-com bubble burst. Now, this stock went down 90%, even though every single quarter during that decline, their earnings and revenues improved, and their margins, et cetera. But the stock had gotten too far ahead of itself. Now, it had gotten way more than ahead of itself than the AI stocks did. So I'm not saying Nvidia and these names are going to fall, 80 or 90%, but they could fall quite a bit. And that's normal and healthy during these big runs. But my point, my biggest concern though is moving a little bit from this is that as we get into the second half of the year and we start to feel the real effects of the credit contraction that's going to come from this banking crisis that everybody seems to have kind of forgotten about, we could see some of these stocks fall back to earth a little bit.
So Matt, just kind of to follow up on this too, and the annexation of how we should be thinking about generative AI, is it more akin to the blockchain moment where you had every company just miraculously become an expert in blockchain technology and saying that they were going to have advancements within the next 18 months for their customer base? And where did that fizzle out? Or is this more akin to a smartphone moment where it is viable to have companies saying, all right, we're going to have this solution, and also other clients and customers of theirs saying, we're going to invest tens of millions of dollars, like KPMG had put in their survey, saying that their C-suite leaders are going to invest in artificial intelligence, $10 million, many of them, in order to advance tax solutions, or Oracle saying that it's going to reinvent HR solutions as well. So what is this more akin to?
I think it's more akin to the issue with cryptocurrencies, and the reason for it is the iPhone or the smartphone situation came on more gradually, and it took time for it to take place. The similarity we have between what happened with the cryptocurrency and now is this excess liquidity that it got thrown into the marketplace. After the pandemic, we all know what happened with the Fed and all the global central banks, and for that matter, fiscal policy as well. But they flooded the system with liquidity, and that took the cryptocurrencies, which were already strong and already rallying already, way, way higher than they would have otherwise gone. We saw the same thing happen this spring when the regional banking crisis took place. We saw what happened with the Fed's balance sheet. They injected for a short period of time a massive amount of liquidity back into the system, and these AI stocks jumped way more than they would have otherwise. This thing will be a more gradual thing like the smartphones, and it will play out very, very nicely. The problem is we may have to see the kind of pullback we saw in the cryptocurrencies at some point in the middle because of that artificial injection of steroids that we got from the Fed because of two different crises.
All right, excellent breakdown and analysis on our top story of the day here. Stay with us, Callie and Matt. We've got much more to discuss. The Fed is in focus for investors today as Chair Jay Powell takes the stage at the European Central Bank, their annual forum. Powell will be on a panel focused on monetary policy, featuring other central bank leaders, including the Bank of England Governor Andrew Bailey and European Central Bank President Christine Lagarde. Now, this talk comes after the FOMC decided to pause hikes in June while other central banks opted for further tightening to help bring down inflation. Compared to other nations, the U.S. isn't doing so badly in the fight against inflation, so we will see how markets react when comparing Powell's tone to other more hawkish central bank heads. Let's bring back in Callie Cox, eToro USA investment analyst, and Matt Maley, who is the Miller Tabak Managing Director and Equity Strategist here. Callie, when you think about the tone that needs to be struck at this meeting of governors that is essentially going to kind of give more of an inclination as to where the global economy will continue its recovery, what is the role that Fed Chair Jay Powell can play within that tone?
Well, this is an important panel. Let's start off with that. We have a bunch of these world leaders talking about central bank policy at a time when a lot of central banks are out of step and dealing with many different crises. I mean, the inflation we see in Europe is more supply side driven. We can't say the same about that in the US. A lot of that is demand side driven, meaning that people are spending a lot of money and that's pushing prices higher. So Jay represents that part of it. The US, obviously, but the fact that demand is too high in the US and the Fed has a reason to keep rates high at the moment. And that contrasts with the ECB, with the European Central Bank, but other central banks as well, where they have a trickier situation at the moment. They really are at the mercy of supply chains and certain resources that they have to get from other countries. So Jay is a bit of an odd duck out on this panel. I think it's really important to hear what he says, of course, because we are the US, but because we are also in that different situation. But one thing that I'll add here too is that I think markets are digesting this idea of higher rates really well. And I think Jay really put his foot down last week and markets heard him.
Is this thing going to be market moving today, Matt?
I kind of doubt it, but but the one thing is that, when is this all going to sink in? As Callie mentioned, that the markets are digesting it very, very well, and maybe they will continue to. But there's no question that, the narrative which had been higher for longer for a while was fading. Well, that's come back in a big way. In fact, the one former vice, I read a quote from one former vice chairman from the bank, from the Fed, saying is that they're actually looking for 3 more rate hikes, and maybe the third one coming next year. These are the things we're just, a month ago, people were saying up, or even just 2 or 3 weeks ago, hey, the Fed's done. I mean, this pause is for good. They're basically done. Now we're definitely hearing 2 more. And then, of course, as you just talked about, these other global central banks have raised rates, pushed harder that they're going to raise them even further and even give us a one surprise rate, in terms of the size, a surprise rate hike from the ECB. So I think that this higher for longer is a situation that we do have to worry about a little bit because, we have a stock market that's trading at almost 20 times earnings now. When you get those high valuation levels, they're harder to justify if rates are indeed going to stay higher for longer.
I'm looking at the CME Fed Watch tool right now, Matt, and it looks like about a 74-75% chance that they are going to hike at the next meeting. You look further out later on into next year, and with any type of surprise hike that we could see, so 50 basis points through the rest of this year, what does that spell out then going into 2024? If we were at that point, as many banks have told us in the last earnings season, that we could see a recession begin in Q3 of 2023.
Yeah, I mean, it's, again, you go on to things where again, there's this change. And we saw what happened with Morgan Stanley, who 2 weeks ago were saying no more rate hikes. And just yesterday, they came out and said, definitely a rate hike in July. And what does it mean on a longer term basis? Well, I mean, the big concern is, the Fed, people keep talking about the Fed's going to keep tightening until something breaks. Well, something already broke a little bit in the spring. Are they, people really wonder if they're really pushing, they're going to keep pushing until we get that recession. I mean, the one thing I've always said is that the Fed, even though they're always data dependent, they're also somewhat market dependent. And they don't like some of the froth that's built back into the marketplace. So if we do have this recession again, if we don't, I guess my point is, if we get a slowdown in growth, which I think is very likely going to happen, that's going to have an impact on the stock market. We have to remember that when the market gets really expensive, it doesn't matter. I mean, we had the mildest recession, one of the mildest recessions in history in 2001, and yet the stock market got clobbered. Now, again, I'm not saying we're going to have that same kind of a bear market, but my point is that when this market gets as expensive as it is today, a slowdown in growth and lower earnings that will go with that will make it tougher, a little bit tougher sledding than I think a lot of investors are realizing right now.
Callie, what do you think? Where are we going markets-wise? Okay, we'll put aside the recession for a minute. I'll just focus it on the markets question and where we're going from here.
So I'll say this. I don't think rate hikes matter or future hikes matter as much as how long the Fed will keep rates higher, because rates are already at 5%. That's a 15-year high. If we see hikes from this point, barring any surprising circumstances, they're going to be 25 bips here and there. That doesn't matter in the grand scheme of things.
I mean, it seems like they're going to keep rates higher for a while.
Yeah.
Into next year, probably, right?
Yeah, as long as we don't see a recession, there's no reason to cut rates. Jay has made that very clear. And if we see a recession, we have more problems on our hands here. So I think we'll continue to see this rotation into bigger quality, more durable stocks, which, to be clear, I think that's why a lot of people gravitated into big tech earlier, because they see these big tech companies as, higher profit margins, pretty strong balance sheets as well, bigger cash hoards, the type of companies that you think can make it through a recession. So do prices move higher? Depends on how this rotation plays out. But at the same time, I don't think this is the point where you dive back into speculation just yet. It's tough to do that in a high rate environment.
Yeah, definitely. All right, guys, stay with us for just a bit more. We are almost midway through the calendar year, and stocks defied expectations in the first half of 2023. But with sky-high inflation and rising fears of a potential recession, investors are searching for the best summer portfolio plays. Could it be time for defensive stocks to help recession-proof portfolios? Callie Cox, eToro USA investment analyst, and Matt Maley, Miller Tabak equity strategist, are still here with us. So, Matt, let's start with you on this one. Where you think people should be positioning here going into these summer months and this sort of period of uncertainty, although I guess we're always in a period of uncertainty at this point.
That's for sure. I mean, it's, and now with all the stuff going on in the whether it be on the domestic side or the geopolitical side, there's a lot of uncertainty. And I do think playing it a little bit more defensive after this big run is a good idea. I mean, we look at some of these consumer staple stocks. They're not the cheapest things in the world, but they look again a good place to hide, because if the market does rally further, they'll still go up, and you'll be able to take advantage of any further rise in the overall market. But again, with these tech stocks being as extended as they are, both on a technical and fundamental basis, I'm going to avoid those and for now and look for them. And again, I'm not saying start dumping Apple or Microsoft. I'm not saying that at all. But if you want to add to them, look for them at lower levels and maybe go into these little bit more defensive sectors. Another one is the healthcare sector, which has been beaten up again a little bit recently. I'd be a little bit less on the biotech area and more on the more traditional names. But the one area that a lot of people who've been liking and that I've liked for a long time that I don't like as much as I did is the energy stocks. It's again, it's not a group I'm looking to avoid, in other words, start selling, but it's one you want to hold on to and again look for lower prices. I just think with what's coming what's coming with a credit contraction, that's going to cause a little bit of a slowdown in the economy. That should cause demand to come down a little bit further, and I think you get a better chance to buy these energy stocks at better prices later in the year.
Kelly, what about you? Top sector that you're looking at right now?
Okay, I'll break it down this way. So I think you need to keep your feet in both camps here, because we are in a bull market that signifies some kind of psychological change. And historically, we've seen a lot of momentum in the first year of bull markets. The S&P has risen an average of 43% in the first year of all bull markets since 1950. That is a tough move to miss out on. So when I think about sectors, I think about the economic trend. The economic trend is pretty clear. The Fed is the economy in a vice, so that makes cyclicals a little less attractive. Think about the fact that we have an uncertain future before us, and potentially a more uncertain future than at other times in past bulls. So look at defensives. Think about where your portfolio is. Think about how exposed you are to the economy. Look at defensives, but also keep your foot in some quality risk as well. Going back to the big techs, going back to the bigger companies in those rate-sensitive sectors. I mean, think about the companies that could survive a recession, and don't be shy about taking on a little bit of risk, because there could be a bigger upside move from here. Nobody really knows. So I know that's a bit wishy-washy, but I think when there's a rotation happening, an obvious rotation, you have to keep yourself in a barbell. We call it a barbell portfolio. Really, again, sticking your feet in both camps.
And Matt, I'm curious also how you're thinking about, I know you focus on equity here, but how you think about fixed income and the balance here in our portfolio.
Yeah, I mean, I guess I do think that we're going to have some great opportunities if the if the economy slows down, like I think it will. I think that's not going to come immediately, but I do think you're going to see some good area in the safer parts of the market. I mean, if the bond market, the Treasury market rallies, you're going to have some areas that again. In other words, if the economy slows down, that means yields will go down, and that means the bond prices will go up. That's going to, someplace where you're owning the 2-year Treasury note is a good idea. However, if the economy starts to slow down, you got to be careful of the high risk, high yield bonds, things like that. So in the fixed income area, I think you want to pick your spots. I think you're going to get, because yields are going to stay higher for longer, that's probably something we'll get halfway or maybe towards the end of the summer rather than right now. But I do think as the economy slows down, with this credit contraction coming, I think that's going to be a good place to, also be a little bit defensive.
We're discussing this as we're about to kick off another earnings season in just a couple weeks here. And so that considering, there have been calls that there needs to be a reset of some of the earnings expectations, which I thought we had already got some of that reset and beat on relief in the most recent earnings season. Are we set to just once again kind of repeat that relief type of rally, even if we were to see companies once again reset or actually just beat on what they had already put out in terms of some of the suppressed guidance that had come out during Q1?
Yeah, to me, that almost sounds like the drumbeat of what we've heard before the past few earnings seasons. This is the quarter where we see companies completely blow it out, or not blow it out of the water, but blow it. Not do as well as people are expecting. But the truth is, I mean, PPI, we've seen how PPI has reacted. PPI is, the cost of raw materials to these companies. Inflation is falling. I think we're underestimating the, role that costs could play in keeping profit margins high. So, stepping into this earnings season, I think that there is more optimism compared to past quarters. But at the same time, there is this negative air, feeling in the air around corporate earnings, and companies have surprised us time and time before. I mean, the S&P has risen during the past few earnings seasons, mainly because we got too pessimistic. So I think costs will be the theme of this earnings season, and the fact that we are underestimating how well companies are handling costs and what costs mean to margins.
Interesting. Okay. Thanks, Callie. And Matt Maley, thanks to you, Miller Tabak, Managing Director and Equity Strategist. Callie's going to stay with us. We got all your markets action coming ahead. You're watching Yahoo Finance.
Investors will decide when the AI bubble bursts. And here's what we mean by that. As you were just citing, some of the analysts that are turning a little bit more sour on the traditional AI plays that have been out there, largely in the form of where companies can get in on the LLM, the language learning model side, or even on the chip side. We've already seen chips absolutely skyrocket, and it's kind of framing one of the stories over the course of this year. And then additionally, I think right now for investors, they're going to have to consider what is the price that we're not willing to pay for this, and where we're going to be monitoring the timeline for what companies promised and how they're going to actually deliver on some of the AI promises into their bottom line as well here. So I would say Q3 2023.
Q3, yeah, I feel that. And I also think investors and users need to see how this plays out, right? Like, there's still a lot of unknowns here, so TBD on that.
Investors are still focused on their long-term goals despite looming macro concerns. A new retail investor survey from eToro showed 55% of investors are still focused on long-term security. Callie Cox, eToro USA investment analyst, here with us in studio. Callie, thanks for taking the time today. Let's dive into some of the findings of the survey. So where overwhelming are you seeing some of investors' attention shifting to right now?
Well, I think you could go a few ways here. So investors, like you said, are longer term. I think that that's a misnomer out there that retail investors are all, day trading and, looking for that short-term stock pick. That's not true. But while they have their long-term portfolios, they are being more tactical on the side. They see that markets are changing and they want to get in on some of that action. So a little bit of both is happening. Retail investors are also diversifying a little bit. They love their stocks, they love their crypto. They know that more risky assets are the path to growing wealth. But at the same time, they feel nervous just like everybody else. And they're looking at bonds, they're looking at commodities, and they're looking at cash. I mean, with the kind of rates we see on cash, I'm not surprised by that at all.
I love some of the insights in this about younger versus older investors. One of them, that younger investors are more worried about inflation, older investors are more worried about a potential recession. I think that's really interesting. I don't know why that is. I guess yeah. older Americans maybe have seen inflation before, right, and they'd rather deal with that than have what they see as the worst outcome, which is recession. But I don't know then how they're making decisions based on those two different views.
I thought this was interesting too. It really struck me at first. And the more I read into the data, the more I saw that it might be that younger investors are less worried about a recession. To be clear, they're worried about it. It was their second
just
highest
relative basis.
Right, exactly. It's all relative. And recession was the second highest risk among those younger investors. But I think it goes to show that, maybe younger consumers are having a better time in this economic environment. And if you look at the job market, I think you can make a good argument for that.
Sector right now, I mean, there's still overwhelming focus among young investors in tech. However, the older investments, they're going into financials. So what are we seeing in terms of who is placing more of their interest, but more so just perhaps old strategy on some of where the market could potentially move in these two sectors?
Yeah, so technology always pops up as one that retail investors are very interested in. That should come as a surprise to nobody. I mean, those are the brands we know and use every day. Financial services also rank pretty highly there. So when I saw the sector survey outcome, older investors looking at banks, younger investors looking at tech, I wasn't too shocked by that. Those are popular retail sectors. I mean, the fact that banks have sold off so much this year for very good reason. It was a little shocking to see that, investors want to pile back in there. And maybe that's, a sign of higher confidence, a sign that, maybe investors across the board feel a little bit better about this market.
Is it clear if that's more towards the regional banks, given that some of them had been battered so much during the banking turmoil that ensued mid-March? Or are they looking and saying, because of that, now I'm looking at some of the largest banks, knowing that they're going to be the ones that get tapped because many see them as too big to fail?
Yeah, so in that survey, we didn't get into that detail, but what I can tell you is that, we see customers, we have seen customers playing the regional banks, ever since March, in both directions as well. And, they've sold off a lot, and now the market is moving higher, and they've been part of that bounce back. So, retail investors love to see action. They love to see momentum for that short-term tactical account, that play account, if you will. So that could be a reason why investors in general are looking at banks. And maybe they're looking at the bigger banks because those are the brands they know. But at the same time, regional banks have been the source of action, for good or bad, over these past few months.
Yeah, I guess we'll find out in the next earnings season whether it is for good or for bad, which way it's going to lean. Callie, good to see you. Thanks for coming into the studio.
Yeah, it was a pleasure. Thank you for having me.
Good to have you. Callie Cox is eToro USA investment analyst. Let's take a look at what's going on in the markets here, because we did have the opening bell on Wall Street. All three major averages here are in the red, down just, let's call it, about 1/3%. It could be here a little bit of the weight of the chip news that we talked about at the top of the show, that report in the Wall Street Journal that the U.S. government may further be restricting the sales of chips made or designed by U.S. companies into China. Also, of course, we are awaiting commentary from that panel of central bank presidents that's happening in Portugal to see if any of that is market moving. So, awaiting all of that. And in view of all of that, there we have the man himself, Brad Smith, at the Interactive, ready to go.
Let's get some charts popping off for the folks at home here as we're taking a look at the opening bell. And we'll talk back over to this other chart that I like just a little bit more as we start the day. Taking a look at the Dow Jones Industrial Average. Right now, out the gate, it's down by about 0.3%. Let's populate this for the course of this week as we are here on this Wednesday, this hump day, if you will. Past 3 days, still higher by about 0.25%, 0.3% for the Dow. But as I mentioned, that percentage basis to the downside here to start off today. Nasdaq Composite, that's lower, 0.3%. S&P 500, that's lower, 0.3%. Past 3 days, still net positive here. All right, so what's taking place under the water? Taking a look first at some of the 11 S&P 500 sectors here on the day. Yeah, you largely got some red on the screen there. The lone gainer here, interesting activity in consumer discretionary. I was actually taking a look at this one before the start of today's trading activity just to get a glimpse of how this first half of the year has been playing out for consumer discretionary, even amid some of the kind of trade down that we've continued to discuss or hear from some of the larger retailers, or even where there's been a pause in some consumers or households on spending in apparel, electronics, home appliances, things of that nature. You're still seeing consumer discretionary right now. That's higher by about 29% year to date. Up here, lone gainer on the day. However, you've got a lot of red. Utilities is the biggest of the reds. And additionally, taking a look at the Nasdaq Composite here on the day, tech heavy average, you've got a good look at another sea of red as of right now. However, some of those mega cap tech stocks trying to hold on to some gains here. The biggest decliners here right now are actually Nvidia. That's down 3% on the day, or at least early in trade. And then JD.com, that's down by about 3.2% here. The reds, that's a technical term.
Yeah, what about the semiconductors overall?
Semis, want to take a look at that?
Yeah.
I got you covered. Semis.
Let's do it up.
Red.
All red because
red.
of that report. Exactly. Yep. And it's interesting that Nvidia is down the most. We're going to keep watching shares of that.
You got it. Brevity.
Let's also talk about shares of General Mills. From chips to cereal. The stock, they're dropping after reporting mixed fourth fiscal quarter results. The cereal company saw margins narrow, eating into profits as inflation continues to take a toll on input costs and consumer spending. So those shares taking a hit of about 4% here this morning on this. And it's interesting, as we have gotten further into the year, initially the narrative with many of these companies was they were able to raise prices even if volumes were declining. Well, is this sort of the early vanguard of what we were going to see in the next quarter? Because General Mills reports on a little bit of a different cadence.
Yeah, and this was not a good one to eat your breakfast over this morning as we were taking a look at some of the results here. Some of the major outlook that they had provided here as well. Organic net sales, they are still expected to increase for the fiscal 2024 outlook by about 3 to 4%. Adjusted operating profit also expected to increase by about 4 to 6%. And then additionally, EPS expected to increase 4 to 6% as well here. But they had some serious segment concerns here. Overall, if there was one thing that I was continuing to look through, it's not just in the North America retail segment, where particularly even though over the course of the year they had said there was favorable net price realization and mix, that was unfortunately offset by lower pound volume. So even as the volumes were moving lower, they were having to increase price so that they could make sure that they were maintaining revenue base and to a certain extent the margin base that they were expecting.
Yeah, I'm looking at these volume numbers. Organic sales volume overall down 6 points. North American retail organic sales volume down 6 points. Pet organic sales volume, because they have a pet business as well, down. North American food service volume down. International volume down. You get the idea. And all of those numbers, by the way, were down more than analysts had estimated. And in some cases, analysts had predicted a gain, particularly in pet, and they got a decline. So they really got walloped by those volume declines, it looks like.
All right, we're going to keep an eye on the Fido trade out there with that pet segment.
Yes, we will. Let's talk about Jefferies as well. The Jefferies Financial Group on the move after second quarter results showed a continued lull in deal making. Revenue in mergers and acquisitions was down 32% for the private lender. Jefferies results could be a look ahead to the bigger banks, which will report in mid-July. What's interesting here is the shares were down after the company reported, which was after the close yesterday. And as you saw, they have since turned higher. So not sure exactly what to attribute the change in sentiment here, because you heard some of the numbers. They weren't great. CEO Richard Handler and President Brian Friedman saying in a statement that it's a cyclically low period and particularly challenging environment. They also said that they saw sort of a ripple effect from the regional banking crisis, even though they're not a consumer deposit taking institution, but they do business with those institutions, right? So it's interesting here that now the stock has turned around at least.
Yeah, I'll just read part of that quote actually to your point there. They said that the challenges in the operating environment during the second quarter, they included the fallout from the regional banking crisis that you mentioned, government-supported forced merger of Credit Suisse and UBS, and then the tumultuous process of extending the U.S. debt ceiling. This is one of the first, I think, mentions that we've heard of the U.S. debt ceiling showing up in an earnings report. Of course, much of the earnings season had really kind of perspired prior to the debt ceiling talks or negotiations really concluding in full. But also, as a result, they saw uncharacteristically low volumes of capital market issuances and M&A activity there. So that's going to certainly hit on a company like Jefferies and how they account for where their revenue comes in from. And it's deal making at the end of the day, too.
Yeah, definitely. So we'll keep watching, see what the shares continue to do.
Hey, we've got the logo up on the screen. Pins, that's up by about 6.5%. This was a fun one to read this morning. Pinterest stock moving higher today after an upgrade from Wells Fargo. Analysts boosting the social media company's rating to overweight from equal weight and lifting its price targets to $34 a share. Also highlighting Pinterest's partnership with Amazon as a possible boon to revenue growth there. And they mentioned specifically that it's a partnership that would be activated prior to the major spending that would take place during not just the holiday season, but even potentially back to school season as well.
And this is interesting, too. They are looking at the Wayfair pre-announcement as a harbinger of improving end market trends. That's something else they talk about in this note because of Pinterest's exposure to retail and e-commerce, that would be, and especially because a lot of people are pinning beautiful rooms on their Pinterest boards, that maybe furniture could be a helpful, that Wayfair pre-announcement or forecast could be a helpful forward indicator. You look skeptical. I'm reading that as is that the Brad Smith skeptical look? Or
I'm just trying to think about my own living environment and where I need to perhaps replace some furniture. I don't know.
I definitely.
I'm not in the Wayfair trade right now. So
no, I mean, I, as you know, I moved into a house a couple of years ago, and there's definitely still stuff that is not furnished.
Okay, all right.
There's lighting that's not done. Right. It takes a long time.
All right, so I'm
still in that trade, I guess.
I've got the shipping container home and the treehouse tabs on mine. You've got the Home Deco tabs on yours.
Are you using like TV trays still for stuff?
Oh my gosh. I can help you with that. I know exactly what I'm getting you for your birthday.
I know, it's not good.
All your markets action straight ahead, everyone. Stay tuned. You're watching Yahoo Finance.
Well, for me, I'm a media reporter, so I cover all the media stocks. I'm very worried about these traditional cable companies, especially a company like Warner Brothers Discovery. We saw the flash bomb at the box office. We have CNN CEO Chris Licht. He was fired about a month ago, and there's just a lot of problems at this company, especially as we see cord cutting escalate, everyone going to streaming. So you have to wonder where some of these companies like Paramount, Warner Brothers Discovery, Disney could even go from here, and I think that's going to set up a lot of media consolidation down the line.
Tech stocks are slipping today as concerns arise around AI chip exports. So what should investors expect for the last few trading days of the quarter and the half? Yahoo Finance's Jared Blickery joins us in studio now. Hey, Jared.
Hey there. Well, I was taking a look historically, and when we have the Nasdaq up big in the first half of the year like this year, and I did take a bit of time explaining this yesterday, so that video is out there. Depends on how volatile the price action is, but when it's been somewhat volatile like this year, it actually bodes well for continuation of the trend. It's when you climb that wall of worry and you don't have those pullbacks that things get dicey in the second half of the year. So maybe things will be good, but I think there are a lot of variables here. Nevertheless, we can see everything in the red over there on the left-hand side of your screen, except for in Canada, we got the TSX up about 9 basis points. Just want to show a year-to-date chart of the S&P 500, and here is the local high, and you can see today's price action pretty close to that high here, so really just off of those highs of the year. Also want to check in on the VIX, which has been depressed. Good for stocks. Low volatility means risk markets have room to run their way. We can also check out bond market volatility, and that ticked up. That's that little green bar yesterday, but still camping out at the lowest levels since February, so not seeing a lot of volatile price action there. And here is the 10-year T-note yield, still in this trading range as it has been for most of the month of June, notwithstanding this little dip right here. So again, not making any waves. It's when these moves in the rates and also the US dollar index we see here break big to the upside or the downside that we get some continuation. But for today, really not seeing too much. I want to point out something, and that is that sentiment is getting stretched to the upside, and that is measured in a couple different ways here. Let's see if we can pull this up. Here is optimism. This is Oxford Economics Risk Sentiment Indicator. You can see it's a composite of 10 individual measured, and it is at the highest levels since 2021, and this is right around where a lot of stocks started peaking in that year. And we can also check out the Fear and Greed Index. It's a little bit more well known. It has ticked up to the greed zone, 76 out of 100. So we're in extreme greed, but it's not extreme greed, I guess, if that makes sense. And then you take positioning. Positioning is getting up there as well. So all of this points to the potential for an eventual reversal, but right now we are actually climbing that wall of worry. Finally, a note on the recession talk and the inversion talk. This note comes from Jonathan Golub, and I just wanted to point this out. For now, the uninversion. For now, Treasury futures imply that the curve will first uninvert in 2026, and this follows a sudden and radical change in positioning. At the end of April, that's only a couple of months ago, futures predicted uninversion as soon as April 2024, and so that's when the economy gets back to normal. Now it's being pushed back to 2025, and here's what Golub is saying. The recent shift in economic outlook, at least partially, justifies strong year-to-date returns, and that's because this makes intuitive sense as the yield curve steepens when the Fed cuts rates in anticipation of a downturn. My question is, if we're expecting this to happen in June of 2026, what happens in the meantime? Are we going to have this Goldilocks economy where we have slightly below trend growth, but also low unemployment and lowering inflation? I don't think that can continue. So I think these bets are probably optimistic that we're going to see a Goldilocks economy evolve this long in time. But nevertheless, that's what the bond market is pricing in right now. So somebody's wrong.
Somebody is always wrong, it seems, Jared. In fact, this was one of the things I wrote about in today's morning brief, so people can read more about that and that commentary that Jonathan made. Thank you so much. Appreciate it. Well, Washington may be weighing new restrictions on chips exported to China. That's according to a new report from the Wall Street Journal. And this comes as analysts are looking ahead to Micron's earnings after the bell today in its first report since committing $600 million to build out its Chinese factory. That's coming after the country banned Micron from supplying its chips. And Stifel issuing a bearish call ahead of Micron's earnings report, saying China poses another detour in the chipmaker's path to profitability. Brian Chin, the author of that report at Stifel, is joining us now. Brian, thanks for being here. Obviously, a lot of moving parts here this morning as we look at this new report out of the Journal. I want to ask you about that first. That doesn't seem to have further implications for Micron, if I'm reading it correctly. But tell me if I'm wrong. What does that report mean for Micron and the other chip makers that you cover?
Yeah, so Micron is the chip maker that I cover here at Stifel, but I'd say these restrictions or potential restrictions seem to be levied towards GPUs, which is not what I cover specifically, but one of my colleagues does. So I would say that the Micron ban is sort of in its separate sort of zone relative to maybe the potential discussion that's being talked about this morning. And that was pretty clear about a month ago. China said that some users of critical infrastructure within China are going to be restricted from using Micron chips within their products. And so really the question is, what is the definition of that critical infrastructure and how significant, could that pose a revenue risk? And we think that kind of starts to pop in maybe in the August quarter, which will be the outlook for Micron this afternoon.
Does this significantly change any valuations and how you would look at these companies, Brian?
Yeah, so what we've been doing, Brad, since the past 3 quarters plus is we've actually used sort of a tangible book value way of looking at this, because what's happened in this downturn is that profitability and even book value has been eroded. And so we've used that really as kind of the anchoring point here. And to really kind of flip the script here and go to a metric that's more based on profitability, we want to see that crossover back to profitability occur. And right now, we don't model that occurring for Micron. And I think consensus is there or thereabouts with us. It's not until the May quarter of next year when we see that crossover back to profitability. So that's kind of something we're looking for to maybe pull in to maybe get even more constructive on the stock right now.
And how should investors be thinking about the China part of it? I mean, as you write in your note, what's going on already, not today's report, but what we already know about Micron in China could affect 12 to 13% of its total sales. But when do we sort of expect more clarity on that?
Yeah, so again, that initial restriction was announced about a month ago. And subsequent to that, the company has come out in a couple of different forums, and after initially trying to quantify that as sort of like a low to high single digit risk, updated towards the high end of that range, updated towards say 12 to 13%, kind of low teens. And so every subsequent update over the past 4 weeks has been kind of to the negative. And so the way we look at that is sort of, if Micron's exposure is 25% in China, the worst case scenario is that 25% goes away. I think that's a little bit harsh, but the best case scenario was kind of the initial discussion points or quantification of that. And so, I think there's probably some natural reluctance of people building products in China, phones, PCs for consumption within China. There might be some initial reluctance to necessarily use Micron until they get further clarity, which isn't to say that they won't eventually be okay shipping into certain entities there. But I just think there's that kind of confusion could bear a little bit more risk in terms of the August quarter outlook.
And so in the outlooks that we're expecting, not just from Micron later on today, but even further updates around where these partnerships among the chip making side of the generative AI kind of hype phase that we've seen thus far, where that will actually kind of get us into the margin generation phase, as you were laying out a moment ago. What kind of reasonable timeline should investors expect there?
Yes, I think the question is sort of, when does some of the potential positive stimulus from infrastructure to build out generative AI start to maybe impact companies, chip making? It could be, Micron. It's hard to say precisely, but those aspects of AI compute seem to account for maybe just a single-digit percent of total consumption for memory today. And so certainly something that we think is going to grow significantly over time, but I'll bring off a low base. And Micron specifically, they backed a different technology than high bandwidth memory initially. And so they're kind of having to play a little bit of catch up, I think, in terms of competitively. And we're looking for signs that they're going to be successful doing that over the next half year or so. And so I think it's certainly a positive in sort of what's been multiple quarters of mostly negatives in the memory space, but maybe still not moving the needle to compensate for sort of the sluggish demand in phones and PCs that we've seen.
Yeah, and what would sort of, you've got a hold on the stock right now, what would sort of unlock value for you at Micron? What would change your opinion? What would be that key sign that you're looking for that demand is improving, or to change your thinking on the stock?
Yeah, I mean, kind of the one thing we say and we've thought, and it's played out over time, Julie, but it's pricing is really the key fulcrum in any time we model estimates for a memory company or company, obviously like Micron. And so right now, you really would need a V-shaped recovery in pricing in order to, that could quickly regenerate margins fairly rapidly, right? And the issue being that of late, memory suppliers like Micron have had, let's call 2 to 3 quarters of inventory on hand. And the target level is probably about a quarter, right? So you've got sort of this higher elevated inventory, which may even rise a little bit based on the near-term China effects. And really, you want to see some of that really cleared out in order to recapture some of this pricing power. And that would flow into sort of the V-shaped margin recovery, pricing recovery and margin recovery that we'd like to see to get us more constructive.
Well, we're looking ahead to those numbers after the close and looking forward to them. Brian Chen, thanks for helping us set up for that. Analyst over at Stifel who covers Micron. Thank you.
Yeah, thank you for having me.
Just wanted to quickly mention some headlines. We keep talking about that panel that is happening in Sintra, Portugal with the heads of the central banks. Jay Powell, the head of our central bank, the U.S. one, said that he will not take hiking interest rates at consecutive meetings off the table. He has talked in the past about doing it in sort of a stutter step way, maybe raising, then pausing, then raising, maybe raising once, then seeing what's going to happen. But it sounds like he's not ruling out any of his options as he has that discussion with the heads of the central banks of the U.S., Europe, Japan, and England. And we'll be right back.
I think the last Fed meeting, it was a bit surprising to see them hold rates steady, but indicate that they're going to be raising rates 2 more times. It's a little confusing for investors. What more do you need to see? Why are you holding? Why are you pausing? Should you just raise rates now if you're planning to do that later? So I think there's a lot of push and pull right now from the Fed that investors are trying to grapple with. And yes, I do think that's going to cause chaos in the markets and chaos from an investor perspective on which way you go. Anytime you have anything to do with interest rates and how it affects people's money, that's going to cause some chaos.
We've got much more coming up in the next hour. The new CEO of Restaurant Brands is going to join us to recap his first few months at the helm, so stay tuned for that.
Plus, several bearish calls on Tesla have left investors wondering where to turn. We'll get an update with an analyst from Guggenheim in the next hour. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Got to be anything AI related, right?
I'm sick of talking about AI, but that's the point, right?
Yes.
Everyone is getting in on this boom. All the big companies out there, they're trying to capitalize on it. So I think that has to be the story of 2023 for sure.
It's been the FOMO moment for AI. Nobody wants to miss out on the AI train, especially if they have any type of opportunity to get in early before that multiplier effect takes place. For a lot of executives that are saying that this could be the next type of cell phone multiplier moment here, investors are not wanting to miss out on that action, and that's been the story of 2023 so far.
Absolutely.
Welcome back, everyone. It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. We're 30 minutes into today's trading action and taking a look at the U.S. major averages here. Right now, we are down across the board. The Dow lower by about 0.4%. That's slipped just a little bit lower from when we started off the session. The S&P 500, you're seeing that sitting at about 0.3%, 0.4% in decline on the day, and then the Nasdaq, that is down by about 0.2%. We'll round that off too as of right now. Let's take a look at some of the top movers this morning. We're watching chip makers as they take a hit following a report from the Wall Street Journal saying the U.S. is considering new restrictions on exports of artificial intelligence chips to China. The move is expected to limit the second largest economy's ability to build its AI capabilities following restrictions in 2022. Those shipments and those halted shipments of the most advanced AI chips made by Nvidia and AMD.
We're also watching shares of Overstock. It's getting a little boost on the news. A judge has approved the e-commerce company's $21.5 million purchase of Bed Bath & Beyond's assets. In particular, not the physical stores, but rather the defunct retailer's brand name, its intellectual property, and its online platform, not though those retail locations or the Bye Bye Baby brand. A U.S. bankruptcy court judge saying in the hearing he was gratified that the winning bidder would keep the brand alive. I guess the judge is a fan of those 20% coupons.
Probably got some in the drawer like many of us. And lastly, we are watching Zoom Info this morning. The stock is rising as Needham initiates coverage with a buy rating and a $35 price target, a boon for a stock that doesn't get too much attention on the day in, day out basis. But take a look at shares here on the day. They're up by a little more than 5% on that from Needham.
A recession by year end. Is it to be or not to be? That is the question. In today's morning brief, I explain how one indicator cited by Credit Suisse says the next recession could be as far as 3 years away. This was really interesting, and it's based on a note out from Credit Suisse's Jonathan Golub and his team. They're looking at Treasury futures. And what Golub says is that it's actually when the yield curve uninverts or steepens, to put it another way, that's when the economy enters a recession. And he says Treasury futures right now aren't implying that we're going to exit inversion until 2026. Now, as Jared Blickery pointed out earlier, like what's going to happen in between now and then?
Yeah.
If that's the case, the market is not always right about these things, but it is interesting that that is what the market is pricing in at this point in time.
It's a question of how much that would also impact the consumer behavioral patterns too. If you were to hear tossed around
True.
the R word for that long of a period of time, when we had already had that in conversation from economists start to get thrown out into the scenario back in 2022 as well, after the transitionary inflation expectations that the Fed had were seen as something that would drive the next recession because of how hawkish they would need to be and how concerted that attention would need to be on curbing inflation as well.
That is a very good point. And the Federal Reserve Chair himself, Jay Powell, has been speaking right now. And among other things, he says the U.S. economy has been quite resilient. He also says the Fed is not ruling out raising interest rates at consecutive meetings from here on out. There you see him speaking in Portugal. Our next guest says the recession could be much sooner than certainly 3 years away, or even maybe the end of the year, based on initial claims data. Joining us now is Tuan Nguyen, who is RSM U.S. economist. Thank you so much for being here, Tuan. So, we hear what the Fed chief is saying. We look at what the data is showing. Let's focus first on your research into jobless claims and what that is telling you.
So we're looking at jobless claim number, initial jobless claim, continuing claims, and according to our new study, instead of looking at the raw level of claims, which is around 260K, at the moment, we are more interested in the pace and the persistence of the upward trend. Now, the mainstream view in the market at the moment is clearly we're seeing an upward trend, but the raw level is still low compared to historical norms. Now, I think it's kind of intuitive that we should have a different threshold for the raw number, given the changes in the economic condition, the labor market conditions that we have seen since the pandemic. So to get that threshold number, we look at the 3-month moving average of initial jobless claims and compare it with the 12-month low. And at the moment in June, we're seeing that the percentage difference is around 21%, 22%. Now, historically speaking, whenever we hit that threshold in the past, we either months into recession or fast approaching one. Of course, is a necessary condition, but it's not a sufficient one. We need to see more of that trend continue to be sure that we are hitting a recession.
And so for the employment situation and how kind of stable it's remained to this point in time, obviously that makes the Fed's job that much more difficult. But what particularly in some of the areas of weakness that we've started to see emerge would you be paying the most close attention to? And are there specific sectors that would have some type of outsized weight versus others?
That's a really good question, because moving forward, even though we're predicting a recession, in our base case, still a mild one, and we definitely gonna see pockets inside the economy that we see less of an impact from the recession moving forward, especially in the tech sector with the AI hype at the moment. However, within tech, even within tech, we might see weakness from life science, for example. Clearly, housing market is bouncing back, but housing has been in a quote-unquote recession since last year in terms of pricing, in terms of sales. So there'll be pockets inside the economy that we see weakness, but we also see strength moving forward. Now, I think the key point here moving forward is the timing of the recession. According to the recent SEP from the Federal Reserve, they also imply a recession, but around early 2024. Again, I think timing is everything here, because according to our estimate, we think we might hit a recession around the back-to-school season or early holiday seasons. Now, that will change the strategy in terms of rate hikes. Obviously, July meeting will be a live event, but we are in favor of one more rate hike given the elevated level of inflation. Underlying inflation is still above 4%, even though we might see a 3 handle on Friday in terms of overall PCE. Now, we might see a rate hike in July, and around September at another meeting, because the Fed will be backward looking. So at that point, we only have data from July and August, and we're predicting solid spending at the end of the summer. So there would be no reason to hike another time in September. Now, by the time you get to November and December, there'll be a lot more signs of weaknesses from the labor market and spending. So I think the Federal Reserve will think about pausing in November and December, and then thinking about rate cuts around early 2024 when we see more signs of recession.
Well, Tuan, it's interesting the commentary that we're getting from, we're showing Jay Powell, the Fed chair, up on the screen right now because he's speaking in Portugal with some other central bank presidents. And among other things, he said he's not ruling out consecutive rate hikes this year. He is talking about the economy being quite resilient and thinks it's still possible for the U.S. economy to avoid a recession here. So it's interesting that he still thinks that, he says here, the risk of doing too much versus too little is closer to balance at this point, although he's still, it sounds like, marginally on the side of doing too much. So it does feel like the Fed chair is relatively optimistic right here.
I think he's optimistic, and I think his comment makes a lot of sense based on what they are projecting for the economy moving forward, because they think that the economy will stay strong throughout the rest of the year, and maybe we hit a recession, mild recession in early 2024. So in the meantime, there'll be a lot of reasons to hike more. According to their forecast, they think that 2 more hikes are necessary. In our base case, we think only 1 more hike is necessary, because again, it all comes back to the timing of the recession. We are less optimistic because we think recession will hit around the back-to-school season. So that will change the strategy in terms of rate hikes.
And so if that is the case, going into next year, does that set up something that is more sharp or more severe in terms of where we could potentially see a recession that permeates into next year, and how behavioral economics could transpire from there?
That's a really good point, because usually when we hit a recession, people pull back, consumers pull back. And given the level of excess saving that we are having at the moment, our estimate is around $600 billion. Some other estimates pointing to $500 billion. But within that range, we think that excess savings will run out by the end of the year. So there'll be no more tailwind in terms of excess saving for consumer spending moving forward. So obviously, there'll be no more tailwind from monetary policies either. So we have to depend on the resilience of the U.S. Consumers. Now, that's really the point that I'm trying to make here, that the number one tailwind has been excess saving, and we're going to run out of excess saving by the end of the year. So we think recession might come earlier than the Fed is predicting.
We shall be watching those excess savings numbers as they get worked down, and the spending numbers. Tuan Nguyen, who is RSM U.S. economist, thank you so much for being here, Tuan. Good to see you.
Thank you.
We've got more markets action ahead. Stay tuned. You're watching Yahoo Finance.
All right, what's your song of the summer?
You know, I haven't really heard a song that's sticking out to me right now. I'm just gonna go on the Dua Lipa train. She's always my go-to summer jam, but we'll have to see. I hope she releases some new music. I'm still waiting for that perfect summer song.
Forget song of the summer. Who is the musical person of the summer? And I'm going to say the whole vibe is Charlie Wilson this summer. Here's why. You got new school Charlie Wilson. You got Can I Get to the Yams Charlie Wilson. You got the Gap Band Charlie Wilson. Anything Charlie Wilson touches, you can guarantee. And if you've seen his NPR Tiny Desk concert, that was amazing. Anything he touches this summer, it's going to be fire.
Checking it out.
Yes. Welcome back, everyone. The term ESG is back in the spotlight, but not for the reasons that you might think. On Tuesday, BlackRock CEO Larry Fink said he won't be using the term again. He believes it's been misused and weaponized by the far left and the far right. So, has ESG investing really made an impact, or has the term been used to create the veneer of corporate responsibility? Joining us now is Yahoo Finance's Rick Newman to dig into the topic. Hey, Rick.
Hey guys, if ESG actually goes away, I will shed no tears. The goals of ESG are laudable. I mean, I think broadly put, the idea here is to foster more inclusiveness, more social tolerance, and things like that in corporate America. I just don't think it's been very effective. First of all, some people claim, oh, this actually produces better returns than ordinary investing, or what you might call ETF investing. I just don't, the evidence is not really there for that. It looks like maybe in the short term, yes, ESG portfolios, if you will, might do a little better, but that might be only because there's this like trendy effect where if it's an ESG ticker, everybody wants to get into it, so there's more demand and the price goes up. In the long term, it looks like there's just no difference. Also, how do you decide who's a virtuous company and who should be in your ETF portfolio or who should be out of it? I've spent a lot of time during the last year and a half reporting on energy markets, and fossil fuel companies have been one of the targets of virtuous investors. Let's defund fossil fuels. Let's get out of the fossil fuel business. Well, we saw what happened if you want to do that. Last year, we had $5 a gallon gasoline. People's heating bills in the winter skyrocketed for the last 2 years. And it turns out, holy smokes, we actually need fossil fuels. So why would we defund something that we are still very dependent on? I mean, again, moving to renewables is a worthwhile goal. But we have a lot of ways to affect change in the United States, and doing it through investments just doesn't seem like the right thing to do.
Rick, I have so many thoughts on this, but I'm going to pause this conversation. You and I for sure will continue it, perhaps on air, perhaps a different time. But for now, we have to talk about another topic, and that's President Biden, something else Rick has talked a lot about. President Biden ramping up his re-election efforts this week. He's set to land in Chicago today to deliver a campaign-style speech on his economic vision, known to many as Bidenomics now. So what can voters expect to gain from the president's address? Let's bring in David Gura, his NPR business correspondent. Rick Newman is still with us as well. And guys, this has been thus far a fairly tough sell on the part of the president. I was just seeing some early headlines that he says, maybe the much touted recession is not actually going to arrive. Dave, do you think that he makes a legitimate case here, and do you think voters are going to buy it?
I don't know that he's made it yet. I think he wants to. And what's interesting to me is how he has begun to embrace this term. I think it was just a week ago he was speaking to union workers in the Northeast and talking about how people call this Bidenomics. Where do they get that term? What's it mean? And clearly something's changed over the last few days where his strategists and communications advisors have said, Bidenomics, it's a good term. Let's try to put some meat on the bones of what it is. I'm eager to see what he says. I mean, there is this fascinating kind of binary between how the president sees the economy, understandably, and what we're hearing from the Fed chair, from he and his colleagues at the Fed, just about sort of what is happening, what might happen. We see the president here really embracing, of course, the steady job market that we've seen, which is such a bright spot in this economy overall. I'm curious how he goes beyond that in the comments that he delivers today to talk about sort of getting past, yes, this post-COVID recovery to something more concrete and something that, to your point, Julie, I think voters will be able to understand and to his hope, I think, be able to associate with him.
And so, David, that considered, will this move the dial or have any considerable type of impact in the calculus going into the end of this year and ahead of the general election season?
So there's a bit of a wish and a prayer here. I know you and others have talked about just sort of the likelihood of a recession, what that might look like. Of course, that's nothing that the president wants or wants anything to do with. I think the hope here is one principally of messaging, that he is going to be able to characterize or contextualize what he's done here in a way that will stick with voters. We haven't really heard the other side of that, sort of what his what the eventual Republican opponent or what the group of Republicans have said is their kind of economic strategy going forward here. There have been a lot of attacks on sort of the White House's tack when it comes to the stimulus during COVID and what it's done since. Of course, student loans is a component part of that as well. And I think that the hope here is messaging, that the president will be able to sort of draw a bold underline beneath how well the economy is doing in so many ways, and voters will be able to acknowledge that and again associate it with him and the White House.
Rick, you want to jump in?
Sure. Biden. The question with this branding of Bidenomics is there something real and different here, or is this just his effort to claim some credit for what's going right in the economy? And I think there actually is a new and different thing that you could call Bidenomics, and it is more government intervention in the economy. This goes back to 3 bills Biden signed: the infrastructure bill in 2021. The CHIPS Act in 2022, and then the so-called Inflation Reduction Act also in 2022. We are now seeing the effect of those laws, which is a lot of government money that is now going into the economy in the form of incentives for investing in green energy. We're seeing a factory boom. There is new manufacturing coming online in semiconductors and other things relating to technology. So the question is this going to be good for the overall economy? There are some critics of this who say what this is doing, it's taking money out of the private sector and it's government spending that is going to generate a lower return than private sector spending would. But it is moving the needle. Some people call this state capitalism along the Chinese model. It's not quite that, but it is something different, and it is starting to have an effect. Whether this is going to matter to voters is another question, though.
Yeah, and it's a good question, one that I don't think we have the answer to. And then throw all of this, while we're talking about fiscal stimulus, we have monetary policy, obviously, going a little bit in the other direction. Dave, you've been monitoring what Fed Chair Powell has been saying over there in Portugal at this roundtable of central bank heavy hitters. And as usual, he's hedging, right? He's sort of saying, he's basically giving himself a lot of cover to do what he thinks the central bank needs to do.
Yeah, I'll give some credit to our former colleague, Sarah Eisen. He's trying to wrangle a bunch of cats here. These are some big names. And of course, everyone's perspective is different. And it is a treat to kind of see them all on stage together. And to the extent that they are kind of playing off each other, that's interesting to see. But yeah, Jay Powell is striking a very optimistic tone. He talked a bit about sort of what he characterized the last meeting as. It was funny. Sarah Eisen said, you're not talking about this as a pause. You're not talking about this as a skip. What do you call it? And he said, I call it maintaining the federal funds rate at its current level for this meeting. So a bit of wry humor there and literalism from the Fed chair. But he did talk a bit about the path going forward. And he said the Fed is going to sort of make decisions with a little more time between them. As you said, Julie, sort of noting what he's discussed. He's not opposed to doing rate increases back to back. He talked about the risk of a recession as well. I was struck by the way that he characterized that. He said it is a significant risk. It's not the expectation that he thinks is going to happen here, but he thinks that it is a significant risk going beyond a hard landing to something worse than that. So, he's not wearing a necktie, which is something that's more relaxed.
I noticed that. Yeah, I like that. It's not. I don't think that's what he's wearing to a Dead show, Dave. To be clear, right?
Well, of course, yes. The tie-dye is in the carry-on.
We just learned that, for those of you who don't know, Fed Chair Jay Powell is a Grateful Dead fan. We just recently
lifelong.
Yeah.
That's the extracurriculars that the people need to know, that he is human and he does have some things to do on the side as well when not maintaining the current Fed funds rate as well. David, while we have you, you think largely about, of course, what this consortium of governors actually means, and they're speaking for a body of other governors that have gone out, and there's a ton of Fed speak that we have to evaluate on a speech-by-speech basis or appearance-by-appearance basis. But they're also all concerned about how the market is digesting that. Is the market actually kind of not manipulating, but is the market almost kind of wagging the Fed in a certain direction?
That's a great question. They wouldn't bite at Sarah's questions about that directly. I think what we are seeing is them acknowledging the fact that inflation is obviously a huge issue for all of these economies. And it was interesting. There was an attempt to sort of get them to talk about each other's policies, and they demurred. But they did say that they talk to each other a lot. They're not kind of setting policy in concert, of course, or working through consultation in that way. But they said sort of in recognition of the fact that this is such a huge issue, a huge global issue, they feel the need to talk to each other and talk about what they've experienced and how things are going. But the market disconnect that you're talking about is a real one. I do think that there is a bit of that wagging. And as somebody like you who covers movement in the stock market day in and day out, it can be flummoxing and perplexing to see how, these utterances can cause huge change. Yes, I was talking about what the Fed chair was saying about the prospects of a recession or what rate hikes might be. This is kind of like variation on a theme. Yes, he's saying something that has some semantic difference, but it's largely in line with what he's saying before. And we are seeing markets, I think, get or have seen markets kind of get ahead of the Fed here many times in the last few months.
Rick, I could hear you moving to the end of your seat cushion. You want to jump in?
As shell-shocked as we are with regard to inflation here, this is kind of amazing to me. The inflation rate here is now down to 4%. It's over 6% in Europe. And in the UK, it's 8.7%. Imagine if we still had inflation around 9% in the United States. Biden's approval rating would probably be at 20% instead of the low 40s. So we're getting better here in the United States. But one thing I think we kind of forget is all those price increases that we've had over the last year and a half are still there. The rate of increase is slowing. But for the things that have gone up in price, those prices we really have not seen any prices coming down. We've just seen the rate of increase going up. So I think that might be one of the things that explains why voters remain sour on the economy and sour on Biden's handling of the economy, even though inflation is getting better, which is they're still kind of choking on the price increases we've already had.
Rick, David, really solid analysis here this morning. David Gura, NPR business correspondent, as well as Yahoo Finance's own Rick Newman. Thanks so much, guys.
Hi, guys.
Thank you.
And for more on the health of the economy, be sure to tune in 3:30 p.m. Eastern Time. Yahoo Finance's Shauna Smith and Jared Blickery will speak to Jared Bernstein, who is the White House Council of Economic Advisors chair. That's an interview you won't want to miss. We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Musk versus Zuck in a cage match. Who comes out on top and what's their finishing move?
I guess the question is, can Musk send a proxy fighter in the form of a humanoid robot?
You see, I disagree with you, Brad. I think Musk, he's the bigger dude. I think he's scrappy. I think he's rough around the edges.
Scrappy?
Yeah, I could see him.
It's never a word that anybody has ever described.
I could see him putting Zuckerberg in a headlock for the final move.
Really?
And really winning out here. I just think he's stronger. I know it's a controversial opinion, but that's what I'm going with.
I don't think Musk could beat Zuckerberg unless it was in the metaverse, quite frankly.
Okay.
Fast food's global market share growth isn't slowing down anytime soon. The space reached a $980 billion value in 2022 and is expected to jump to over $1.5 trillion by 2032. That's according to a report from Spherical Insights and Consulting. But which brand is going to lead the charge? That's the big question. Joshua Kobza, who is the Restaurant Brands International CEO, joins us now alongside Yahoo Finance's executive editor, Brian Sazi. Joshua, great to have you here with us. You're new to this role, but you are not new to the company and Restaurant Brands and the operations here. So next 18 months, what really jumps out to you is the first thing that you would really like the company to start on in its kind of reinvention under your helm?
Yeah, Brad, Brian, thanks so much for having me on the show today. It's a pleasure to be here. I've been in the new role for about 3 months now. It's been a fantastic few months. I've had a chance to spend time all around the world in our restaurants, with our franchisees, with our guests, and with our corporate teams. And I think what's most exciting to me about the outlook for us is how much growth we have ahead. And that's the biggest focus for me as I get into this new role. We're spending a lot of time with all of our business units, figuring out where the big investment opportunities are and how we go after those investment opportunities, making sure we have the right leaders in their roles. And we have fantastic leaders running each of our business units. And that's what's got me so excited about the future here.
Josh, good to see you, and thanks for coming on here. So $400 million investment in Reclaim the Flame. That's part of the Burger King reinvention plan. Over the next 12 months, how will that money be spent, and how do you go upon reinventing a burger like the Whopper?
Yeah, Brian. So Burger King's been around for about 70 years now. And we have amazing equities, things like the Whopper, Have It Your Way, Flame Grilling. And we're really going back to focusing on a lot of those core equities that made the brand so special to guests over so much time. I would tell you that the Reclaim the Flame plan is a really exciting new project. It's about a $400 million investment, one of the biggest investments by any franchisor in a brand in the restaurant space in the last few decades. The money's going to be focused in a few areas. The first one is advertising, and you've probably already started to see this. You've seen our new Whopper jingle that's all over TV. So we're putting a lot of money behind bringing some of those core equities of the brand back to life. And we're also putting a lot of money together with our franchisees into the restaurants. We're working on things that we can do in the short run, like improving equipment, improving technology in the restaurants, but we're also doing remodels of the restaurants, taking some of the assets that have been around for a long time and upgrading and modernizing those. I've been in a lot of them recently. It's transformational. It's really incredible for the business. So I think we're just starting to see some of the progress, and we're looking forward to working together with our franchisees and the incredible Burger King team led by Tom Curtis on really reclaiming the flame for Burger King.
Hey, Josh, it's Julie here. What kind of yield do you want to see from all of that? What kind of goals are you setting for Burger King for by the end of 23, by the end of 24, where you want to be in terms of growth as a result of all of the things you're doing?
Julia, it's a great question. There are a couple of things we're really focused on. First, we really want to drive same-store sales. We want to see our business growing. We want to see more guests coming into our restaurants every day. So we're very focused on driving same-store sales. The good news is that's already starting to happen. We saw same-store sales improve in the fourth quarter of last year and improve even further in the first quarter of 2023. So we're starting to see results there. The other really important result that I'm focused on is our franchisees' profitability. Our franchisees need to make money at the restaurant level. That's what allows them to reinvest in their business, to staff the restaurants properly, to remodel restaurants, and to want to grow in the future. And we're seeing a lot of early progress there. We talked about it in the last couple of quarters, where franchise profitability in the fourth quarter of last year was up 40% year on year. We've set an ambitious goal to get to $175,000 per restaurant in the next couple of years, and we're well on our way there. And we're actually looking even further now. We're looking to see if we can get to a next goal of somewhere in the 230,000 range. I think we've got good line of sight to it. And we think it's one of the most important things that's the foundation of a successful and healthy restaurant business.
Josh, you have one heck of a resume, very much geared in all things financial. I believe head of investor relations, former analyst, CFO of the company. Do you think the value of all your brands in this portfolio are being reflected in the company's market cap? And how committed are you to keeping all of these brands under this house?
Brian, so I always say I love all four of our brands. I would love to own each of them individually. I love being part of all four of them even more. And as I said at the beginning, I think what's so exciting is that we have these incredible businesses, incredible brands. It's up to us to make them even more relevant to our customers in more places around the world. And I think that's how we can realize a lot of value and create a lot of value for shareholders over many years to come.
Joshua, we've heard from some of the other execs at your competitors, I won't say names, but that the chicken sandwich wars are still alive. You've got some significant chicken sandwich plays within the portfolio of Restaurant Brands International, perhaps none more so than what we'd seen initiated at Popeyes years back in the virality of those chicken sandwich wars. You think about it going forward, are the chicken sandwich wars over from your perspective? Is it still ongoing? And what is the next leg of it that consumers should expect?
Yeah, so Brad, I think we totally changed the game in chicken sandwiches a few years back with the Popeyes chicken sandwich. It really elevated expectations with customers all across the industry. On top of it, I think we broke the internet with a couple of our tweets and drove incredible interest in the product. For me, it is hands down the absolute best product out there in the space. I don't know why anyone would go anywhere else because our product is so amazing. It's my favorite thing at Popeyes. And we've been doing some new things with our chicken sandwiches as well. We just launched a blackened chicken sandwich, and we're launching even more innovation around our chicken sandwich through the back half of this year. I think it's just a fantastic product, and I'm really proud of it.
Josh, help investors get to know you a little bit. You're the new guy here, leading this a market cap of a company that's about $35 billion, brands we all touch and know well. I mean, you're a young guy, 36 years old. How'd you get this job when you were a kid out there playing wherever you grew up? I mean, did you see yourself in this seat?
So I grew up in Florida. Grew up in small businesses. My parents both had small businesses in South Florida since back in the 1980s and 90s. So I learned about small business, and that's what I love about our business. You know, we work with a franchisee model, and we get to work with small franchise business owners all across the world, here in the U.S. and Canada, in so many countries, and it's all very familiar to me. I also grew up going to Burger King a lot. There's one in our town that I love. I love getting the double cheeseburger, Hershey Sundae pie. We were actually back at that Burger King last week with the local franchisee and Tom Curtis, who runs Burger King. So it's there's so many things in this business that have been a part of my life all along. I'm really thankful to be part of it and to be part of the amazing team that runs the business around the world.
And some really cool ads over the years as well, Josh. We've heard about the nostalgia factor that's been tapped into across the industry to really drum up even more of that kind of marketing connection and cultural relevance with customers right now. What are you hearing from franchisees? Do they want to see a return of the king into some of the marketing campaigns?
Bring them back, Josh.
So I don't know that we're going to see a return of the king anytime soon, but I will tell you I'm really proud of the advertising work that Tom and the Burger King team have been doing over the last 12 months. As I said a little bit earlier, I think they're doing a great job of going back to the core equities of Burger King, focusing on the Whopper, focusing on Have It Your Way, focusing on flame grilling. Those are the reasons that people came to Burger King in the first place, and it became this incredible global brand that it is. I think that we're really leveraging those equities, and we're modernizing them and making them relevant to consumers in a new decade. But I think that's one of the best things we can do. We're putting a lot of investment behind it. We're hearing great feedback, both from our franchisees and from our guests about the advertising, and we'll look to do even more of that in years to come.
Josh, last thing before we let you go, as part of this getting to know you process, fun one for you, because I remember asking your predecessor this. You're on an island, you only can have 3 meals for the rest of your life on that island. Is it our Timbits, Burger King croissantwich, or a Popeye's chicken sandwich? What do you choose?
Brian, I think I need 4 now because we have four brands, but I would probably take a Popeye's spicy chicken sandwich, a Whopper, a Firehouse Italian, and a cold brew to drink from Tim's.
Wow, that's he
good.
just chose them all. He can't choose just one.
Well played, sir. Bring back the king, though. We need the king.
All right, Josh Weckups, who is Restaurant Friends International CEO, and of course Brian Sozzi, who is a big fan of the Burger King one-time mascot. All right, thanks, Josh. Be well. We'll talk to you soon.
Thanks so much for having me. It was a pleasure.
Thanks. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
What's your favorite summer blockbuster, and maybe one you're looking forward to this year?
I am very much looking forward to Mission Impossible 7. I am a Tom Cruise girl. I love those movies. We need some action. We need to bring it back to the box office. You know, a sequel to the Top Gun craziness. So Mission Impossible.
He wants to make sure that we know he does his own stunts.
Yes,
That's what Tom Cruise wants us to know in the age of social media. Tom, you did it. You did it. We all know. We saw you riding off of a cliff. You did it, 6 times? He had to redo that stunt?
Oh, yeah. He broke it. He broke a leg.
He did it well.
Yeah.
Yeah, Barbie's on my list, though.
Of course.
Yeah.
Volvo is the latest EV maker to embrace Tesla's charging design, further bolstering the EV maker's dominance in the charging space. Guggenheim Securities Vice President Ron Yesikov in a note saying Tesla's charging partnerships could prove profitable, but not enough to justify the stock's current price. He joins a group of Wall Street firms skeptical of sky-high Tesla shares and skeptical if they're worth their hefty price tag. Ron Yesikov of Guggenheim Securities is joining us right now. Ron, thank you so much for being here. And this is something we've been talking a lot about and trying to sort of sift through what exactly Tesla gets out of this, of all of these partnerships, right? Monetarily, financially, what it's going to mean for Tesla. What is your analysis telling you?
Yeah, we put out a note earlier this week for clients, kind of outlining the charging business going out to 2035 and looking at the number of electric vehicles we expect to be on the road, just close to 80 million. And what market share Tesla will have, which we think it's 50% plus. And ultimately, our analysis showed that the charging business could generate something like 50 cents of earnings in 2035 in the U.S. And while that's still a meaningful amount of earnings, it's tough to justify the move in the stock based on that. We get something like $10 per share of value to Tesla based on all of the charging announcements. And the stock since the initial Ford announcement has went up about $70 per share. So it's a bit tough to square.
The netting of these partnerships, is that a net positive for Tesla, or is it more so something that is to the benefit of the other companies in traditional auto manufacturing that have been able to step into these charging partnerships with them, Ford and GM?
Yeah, I think it's still an open debate. Obviously, the economics of the charging business flowing to Tesla will be a positive. I think, and we've written this for several years now, that the supercharger network is and will remain one of Tesla's largest competitive advantages. It's a fast, reliable charging network that consumers love. And these partnerships allow access for other manufacturers that specialize in building vehicles to have access to those chargers. And it's been publicly disclosed that Tesla is not going to be charging extra for owners of other vehicles, whether it's GM or Ford, who are part of this partnership. So I think that those OEMs customers having access to the charging network could ultimately lead to share losses for Tesla. But I think that's a time will tell kind of situation.
Ron, you talk about that the case for this charging network doesn't justify the price. Of course, many of your rivals at other firms who are still bullish on the stock, it's partly because of the charging network, but it sort of has to do with the stuff that always has to do with why people like Tesla, right? Sort of grand ideas of what it is going to be, whether it's an autonomous taxi owner down the road, or whether it's going to start licensing its software and technology, what have you. What do you think of those sorts of concepts of what Tesla will be?
Absolutely. It's a great question. I think on FSD specifically, I think our view has been for some time now that as a level 2 plus system, it's very attractive and can be a very good business for Tesla. We have nearly $100 billion of ascribed valuation in our DCF for full self-driving as a level 2 plus system. Where we have trouble bridging the gap is to robo-taxis and the market confidence in robo-taxis. I think we've seen that progress in FSD has been slower than Elon Musk has expected, and with it's really tough to understand where the market's confidence in robotaxis come from. You hear things like data, but the application of that data is tough. You need a lot of compute on the vehicle to utilize that data effectively, and I think it's reasonable to be skeptical if the current vehicles with so-called hardware 3 have enough compute on the vehicle to effectively get to actual robotaxis.
What is Tesla actually monetizing its data look like in practice, Ron?
I don't think they really will monetize the data unless we're talking about licensing FSD, which I think most OEMs have their own strategies around ADAS level 2 plus. beyond that, I think monetizing data is pretty tough in automotive. There's been companies that have tried to do it, and it has been a struggle. But beyond that, I think the licensing FSD would be the main avenue. I just think we're skeptical that other OEMs would actually opt in to FSD when there's viable public alternative or viable alternatives from other suppliers that can offer level 2 plus systems competitively.
Certainly, yeah, we'll be watching. Maybe something on FSD, maybe something on the insurance front as well. Ron Yesikov joining us here today, Guggenheim Securities Vice President of Automotive Equity Research. Thanks so much for the time here, Ron.
Thank you.
And everyone, we'll be right back. We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Investors will decide when the AI bubble bursts. And here's what we mean by that. As you were just citing, some of the analysts that are turning a little bit more sour on the traditional AI plays that have been out there, largely in the form of where companies can get in on the LLM, the language learning model side, or even on the chip side. We've already seen chips absolutely skyrocket, and it's kind of framing one of the stories over the course of this year. And then additionally, I think right now for investors, they're going to have to consider what is the price that we're not willing to pay for this, and where we're going to be monitoring the timeline for what companies promised and how they're going to actually deliver on some of the AI promises into their bottom line as well here. So I would say Q3 2023.
Q3, yeah, I feel that. And I also think investors and users need to see how this plays out, right? Like, there's still a lot of unknowns here. So TBD on that.
The FDA is opening the door in a long-awaited area of study for mental health. The agency issued draft guidance for conducting clinical trials for popular psychedelics. Joining us now for more is Yahoo Finance's Anjali Khemlani. Anjali, what do we know about this one?
I know, this is a fun one, right? So what we know is that the FDA is looking at opening the door, like I said, like you said, for the study in clinical trials of psychedelics. So that means looking at dosing and what the impacts are. They've been looking at this as a way to start studying for potential treatment of depression, PTSD, and substance use disorders, and the popular ones, LSD, MDMA, and mushrooms, of course. So that really is something that we've heard a lot about from advocates in the mental health community on what they see as potential treatments. And, we've seen college and university studies on this. So in the academic space, it's been looked at, and there's been enough encouraging data to get the FDA to start taking this more seriously. There are just a few companies out there that are already starting to create products for this space, but I expect, just like with cannabis, you're going to start to see a huge boom there. From the FDA, though, they are taking kind of a cautious tone when it comes to what they're telling the trial sponsors, i.e. these academic settings and the companies themselves, when it comes to what to look for. And they're saying, quote, psychedelic drugs show initial promise as potential treatments for mood, anxiety, and substance use. However, they're still investigational products, and they should be looked at based on their unique characteristics. So things like hallucination and addiction, that's really a key concern because, as we know, when you just take them out in the wild, which is what it is right now, we know what the side effects can be of that. So very cautious tone from the FDA. They are open to public comment through the end of August, and then after that, we'll come out with some harder guidance. So we'll see, how these trials come along. It's going to be an interesting space to watch.
Yeah, this as the Wall Street Journal the other day had a story about Silicon Valley luminaries recreationally using these, sometimes microdosing, et cetera. So interesting timing. Another story, though, that we have to talk about. We're hearing there may be more wildfires that are happening in Canada with smoke due to hit Chicago, I believe, but also the East Coast once again.
Already hitting Chicago. As of yesterday, they were the #1 in the world with bad air quality, which we know we've been tracking for some time. Meanwhile, Chicago, Detroit as well, Minneapolis, these are some of the cities that are making the top rankings for air quality index. New York coming in a little bit further now. And we know that it's going to hit our area as well here in the New York region. Maybe not as bad as what we saw earlier this month, but definitely some concerning numbers in terms of the haze that you can expect. And of course, the health hazards remain the same: risk to pregnant, elderly, and others with health problems, the impact to the heart, lungs, mucosal membranes, asthma risk really elevated here, as well as the risk for birth defects. So a lot of health concerns that go with this. So definitely mask up if you can, change your air filters, get an indoor filter, all the like. Those are the things that really are a point of concern. We know we heard from New York Governor about the distribution of masks again for commuters and state employees. So definitely putting an emphasis on the precautions that can be taken at this time, and just going to have to watch and see what it looks like out there.
Yes, we will. Anjali, thank you so much. Appreciate it. Well, we got much more to come here on Yahoo Finance. Rochelle Akufo's got you for the next hour of trading.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's what I'm watching this morning. Major chip makers Nvidia and AMD taking a hit after a Wall Street Journal report suggesting fresh curbs on sales to China are on the way. Could this derail any enthusiasm over tech and AI? We'll get into that conversation next. And analyst chaos. A slew of downgrades hit Tesla this week, but one key detail may be causing some confusion for investors. We'll explain as this happens on Musk's birthday today. And taking a vacation at any cost. How to save money on your travel plans this summer. Why a surprising amount of travelers are flying home with debt. We'll discuss. But first, let's take a look at how the major indices are faring so far this morning. Looking at a mixed picture, seeing some oscillation here. Markets trying to digest some of these comments from Fed Chair Jerome Powell this morning. We're seeing the Dow here actually near session lows, down about 160 points or about 0.5%. The S&P 500, they're also just slightly in negative territory there. We're seeing consumer discretionary though, the strongest performing sector on the S&P right now. Tech-heavy Nasdaq there, the only one in positive territory, up about 0.5% there. Although, as we mentioned, Nvidia putting a bit of a drag there under pressure on that chips curbing news. Let's also check in on the Treasury market as well. Just a bit of a flight to safety on those comments, so telling a different story here. We're seeing the 5-year down about 0.6%, the 10-year down about 0.5%, and then the longest term 30-year yields, that's down about 0.1%. Well, here on Yahoo Finance, we get a lot of economists and strategists forecasting a recession for the end of the year. Let's hear from a few of them.
I really haven't seen the market price in yet sort of recessionary conditions.
For our view has always been at the end of this year in terms of recession. We didn't really pull it forward as much as maybe consensus did late last year and early this year. And so we've stuck with the view that we still expect that you get a modest recession by the end of this year.
Even though we're predicting a recession, in our base case, still a mild one.
Well, despite their confidence in a pending economic slowdown, recent data is telling us that a recession may not be on the horizon. Here to break it all down for us is Yahoo Finance's Josh Schaefer. Hey, Josh.
Hey, Rochelle. Yeah, so as those economists were just telling us, right, they see maybe a recession at the end of this year was the initial call, actually maybe even earlier this year. But now some of those economists are starting to move back their call for a recession into 2024. And behind me is one of the key reasons why, right? So Tuesday we had a lot of positive economic data showing overall strength in the U.S. economy. So right here we have consumer confidence. You can see a big tick up right here. And it hit its highest level in over a year yesterday on that chart. Still obviously off some historical highs, but again, a move up. We're looking for upward trends. When you take a look at the Case-Shiller index that also was out yesterday for home prices, you're seeing a similar trend upward, ticking upward over the last couple months, prices starting to come up. And what's interesting with that one, Rochelle, is when you take a look at home sales, new home sales. So the Case-Shiller index is from April. These new home sales are from May. Houses were more expensive, but people are still buying them. That shows consumer resiliency, right? People are still willing to pay for things that are more expensive amid higher inflation and higher prices. That is, again, another sign of a strong economy. Then you take a look at the labor market. We had the May jobs report. It was the highest jobs report for non-farm payrolls we have seen since January. A big tick up here, 39,000 non-farm payrolls. That was a big increase. So it's been interesting to see a lot of these strong data points. We have PCE coming on Friday. We have the jobs report next week. We'll be watching those as well to see if we continue to see these strong data points. But right now it is leaning toward a lot more economists saying that recession is coming later than we initially anticipated.
Interesting to see the tide turning here. Great breakdown there for us, our very own Josh Schaefer. Well, despite economic data, recession fears are still present in the economy and the market. Federal Reserve Chair Jerome Powell said today at a panel at the European Central Bank that more restricting is coming, driven by a strong labor market. His tendency to stick to this hawkish tone sent stocks lower. According to our next guest, it could be time to get defensive. Joining us now is Samir Samana, Wells Fargo Investment Institute Senior Global Market Strategist. Good to see you, Samir. So obviously we have a lot of data points coming at us this week and a lot of hawkish commentary from the Fed here. What is this doing for your recession projections?
You know, we still think there's an economic slowdown probably in the second half, and a lot of it just has to do with kind of the slow nature of, you know, those higher rates working their way through the system. And a really good example is basically when, you know, people sell their homes and they buy a new one and they go to take out a mortgage. Well, that new mortgage probably is going to be higher than the old one. Now, what we're noticing is a lot of people, for that reason and that reason alone, aren't selling their homes. Well, that's fine. You can do that for a while, but eventually, if you have to move for a job or if you have to move for other reasons, you will eventually take out that new mortgage. So the way we've kind of described it is it's like sands creeping into the gears of a well-oiled machine, and it just takes time. So we do think the economic data just, softens into the back half of the year. I think the other piece.
We appear to have lost our guest there, Samir Samana. Hopefully, we'll try and get him back. Wells Fargo Investment Institute Senior Global Market Strategist. All right, well, taking a look with our trending ticker of the day, Virgin Galactic. Stock surging today after announcing that its first commercial spaceflight will take off tomorrow. 2 Italian Air Force officers and an aerospace engineer from the National Research Council of Italy will board the ship and head to the edge of space. Now, this comes 2 years after billionaire founder Richard Branson and his crew took the company's first test flight, showing off the company's progress. All right, stay with us. We'll have much more coming up on Yahoo Finance.
Well, for me, I'm a media reporter, so I cover all the media stocks. I'm very worried about these traditional cable companies, especially a company like Warner Brothers Discovery. We saw the flash bomb at the box office. We have CNN CEO Chris Licht. He was fired about a month ago, and there's just a lot of problems at this company, especially as we see cord cutting escalate, everyone going to streaming. So you have to wonder where some of these companies like Paramount, Warner Brothers Discovery, Disney could even go from here, and I think that's going to set up a lot of media consolidation down the line.
Well, despite economic data, recession fears are still present in the economy and the market. Federal Reserve Chair Jerome Powell said today at a panel at the European Central Bank that more restricting is coming, driven by a strong labour market. His tendency to stick to this hawkish tone sent stocks lower. According to our next guest, it could be time to get defensive. Joining us now is Samir Samana, Wells Fargo Investment Institute Senior Global Market Strategist. Good to have you back here. So break down your recession projections and what sort of recession we could be looking at.
Sure. So we do see a recession in the second half of this year. We think it'll be what's called a moderate one. That'll be enough to solve for the inflationary issues that we're dealing with, but not enough to, kind of push us into the kind of slowdowns that we saw in 08, 09 or 2000, 2002. So what does that mean? That means that at least right now, you should be playing defense. That means move into larger cap, higher quality U.S. equities. We like the energy, materials, and healthcare sectors. We would continue to fade the consumer discretionary and real estate areas. Those are ones that we think in particular will be hard hit by any recession. The other thing is on the fixed income side, we would be locking in those higher, longer term yields that we're currently seeing. We also like the short end. There's some good carry there, with rates now close to 5%. We would not be reaching for yield in those lower rated parts of the credit markets right now.
And we know there was a lot of talk about the strength of the consumer. And for some things, housing, they're still willing to spend. We still see a tight labor market. How is that playing into some of the signals that you're keeping an eye on?
Sure. So there's kind of what you call leading indicators, right? That's the yield curve. That's some of the PMI data that we've seen. Those are still pretty soft. Then there's kind of the more coincident to lagging indicators. And those are the more consumer oriented ones. Consumers usually don't stop spending until they start to face job loss or shaky prospects in the labor market. That's not been the case so far. So again, the consumer may yet continue to spend, but again, that's overconfidence on their parts. And then there's the lagging data, right? That's inflation. Inflation is probably going to be one of the last things to come down. So for those that are hoping that inflation will come down quickly and stay down, we think that's probably one of the biggest disconnects between what markets anticipate and what we see.
And speaking of that disconnect, if you look at the VIX, still slightly under 14. And it does tend to dip naturally in July anyway. But do you think the markets are being too complacent then about the risks ahead?
They are. Again, seasonality gets pretty rough in that August-September timeframe. You also have kind of a lot of the Fed's rate increases working with some lag. As people refinance their auto loans, their home loans, they're forced to pay ever higher rates, right? When you think about what you were paying a year, maybe 2 years ago, whatever your next loan is, you're going to probably be paying a much higher level. And that sand is going to continue to creep kind of into the gears of the economy. And that's why we see a recession in the second half. That being said, keep in mind that the market peaked almost 18 months ago. And so the market's had quite a bit of a head start to mentally prepare for a recession. So while it may stumble once the recession actually gets underway, we may not set new lows. It may be more of an economic shoe to drop as opposed to a market shoe to drop.
And we did hear from Powell more restrictive territory, saying likely 2 more hikes, a possibility still on the table. And part of that dynamic was sort of taking this pause to assess some of the damage, the fallout from the banking crisis. So then I know you're expecting 1 more hike in July. So do you believe that they'll be done hiking by then?
We wouldn't be surprised if they have to keep going. Unfortunately, because of what markets are doing, because of the resilient economic data, right now it's really tough to say that the Fed's job is done. It seems that, things are softening, but then the recent data came out and kind of shows some reacceleration. So again, I think the Fed's going to remain data dependent. Right now, we anticipate 1 more. The Fed themselves think maybe 2 more, but their job just isn't done yet. And I think that's one of those things where we all want this tightening cycle to be over, but I think it's just going to take some time.
And you did say you recommend staying defensive at this point. But so how would you allocate your portfolio? And at what point would you be willing to sort of buy into the equity rally?
Sure. So we would continue to favor larger cap, higher quality U.S. companies. That's a good way to participate. Funnily enough, that area has actually done the best this year because a lot of the tech companies kind of tend to sit in that catbird seat. So that's our continued play there would be, energy, materials, healthcare alongside large caps. And then on the fixed income side, as I mentioned, we would kind of, take the carry where you see it, kind of on the short end. We would lock in those longer term yields. We would stay away from credit. And then as far as, kind of where we would see opportunity, for us, it's really all about price. So we think the S&P somewhere south of 4,000 probably represents pretty good value. So 3,800, 3,900 would be a pretty good run into our year-end target for 2024 of 4,700.
And what do you think would perhaps make you change your projections here? Any sort of data points that you'll be looking at in the coming months, especially as we see what the Fed does?
Sure. If inflation were to shoot down and overshoot the Fed's target of 2% to the downside without a lot of economic pain, that's probably the one scenario that would probably get the markets kind of rev back up from the standpoint of this immaculate disinflation. Again, it's not our base case, but that would be one of the upside risks.
And I know that you tend to have a focus here on fixed income, but of course you have the AI push that's been lifting a lot of these companies and really helping this rally that we've seen start to broaden out in the broader market here. How much weight are you putting on that as people sort of digest how some of these AI uses are actually going to show up for companies in earnings?
Yeah, so what we would say is, price is running ahead of expectations. Again, we don't take anything away from AI. It probably is a transformational technology, but when you think back to the late 90s, when, kind of Web 1.0 was in its infancy, a lot of those companies that were initial winners aren't even around anymore. So it's not that the, World Wide Web went away, but a lot of those companies went away. So from that standpoint, again, we think tech should be a neutral weighting within client portfolios. So you can participate in a lot of the technological innovation. That being said, we would not chase the performance in some of these, kind of high flying areas, because again, we just don't know who's going to be the true winner at the end of the day.
That's true. As you mentioned, their first mover advantage doesn't mean that you have the staying power. A big thank you there to Samir Samana, Wells Fargo Investment Institute Senior Global Market Strategist. Thank you so much. All right, well, big banks in the US expected to fare well in the Federal Reserve's annual health check today. But as we near the beginning of a new quarter, the likes of JP Morgan and Goldman Sachs might be facing tighter profit margins. Let's bring in Yahoo Finance senior reporter David Hollerith to break this down for us. Hey, David.
Hey, Rochelle. So one thing to point out with these stress tests is that after the results come out on Friday, after the market close, it's expected that banks will begin to share sort of their reaction to their results. That being said, there are two more regulatory proposals that we're going to be looking for. One for the big banks, it's the Basel III updates, and then we're also looking for a proposal that's sort of a reaction to what has happened with SVB. And we don't have an exact timeline on either of those. But that kind of draws this point that the stress tests are just sort of the first of three regulatory kind of hurdles that we're going to see banks get through. Again, big banks are going to be dealing with the Basel III, and then the other one, which might be the largest, is going to be specifically for regionals. But on earnings, we're obviously coming to the end of the second quarter. And, I would just point out that deposit costs have gone up for all banks across the sector. And bigger banks, while they have higher pricing power, they're also sort of dealing with what's looking like, record historically low investment banking revenues across the globe. So there's that, and then there's also just been a little bit less volatility than was initially seen this time last year and the year before, obviously. So everything is looking a little bit tighter, and that's kind of just something we should expect going forward. I would say until the end of the year.
So it certainly looks like a bumpy road ahead for banks at the moment. But how much of Goldman Sachs' troubles stem from CEO David Solomon's leadership?
Yeah, this is an interesting point. I mean, I think you can look at Solomon when he came in as CEO in 2018. And since then, Goldman's stock has gone up roughly 40%, at least as of today. And, that's not bad. That looks pretty good. But by comparison to competitor Morgan Stanley, it's not quite as hot. And, there's a lot of criticism amongst the partners about different things Solomon could have done wrong. But the clearest thing is that Goldman has gone into this it's gone deeper into consumer lending and consumer finance. And more recently, they've decided to pull back on that and get back to their roots, which is wealth management and asset management. And obviously, that's what Morgan Stanley has sort of been known for building up over the past decade. And so the thing we're going to be looking at too with Goldman will be whether or not they're going to have any kind of write down on their acquisition of the consumer finance platform, Green Sky. But back to your initial question, though, with Solomon, I think it, in a lot of ways, depends on which Goldman partner you ask. There's about 400 partners, and when things are going great, when partners are paid well, and they're not having to do cuts, you can imagine that they're in a better state. But I think the clear thing that is being scrutinized for Solomon is this consumer, the pivot from consumer.
Indeed. Well, thank you for keeping track of all of that for us, David Hollerith there. Thanks so much. All right, the taste of financial freedom. Younger demographics like Gen Zers and millennial consumers are looking to establish more financial independence from their parents. But according to a new survey by Experian and Atomic Research, more than half of Gen Z and millennials still depend on a parent to pay their bills. So how can young Americans pave their own path for financial success? Let's bring in Teresa Arrigo, Gen Wealth Financial Advisor, to weigh in. Thank you so much for joining us this morning. So first off, set the stage for us. How did they get into this position?
I think there are a few factors that have contributed to this challenge that many are facing. I think if people are like me, having solid role models and education opportunities as they were growing up was lacking. I mean, my family, we didn't talk about money in the house. And so they may have some trouble just understanding what to do. It could be that maybe their parents were avoiding it because they didn't want to sound like they were bragging, or they didn't want to share their mistakes. But there are so many great opportunities for your kids to learn if you're honest about that. And, if your family's tight-lipped, you may feel uncomfortable reaching out for help. And if you find yourself in that situation, I would encourage you to say, nobody's going to get you to your goals if you don't take that first step and reach for them. Another thing that kind of feeds into that is the daily decision making. We all every day have to make financial decisions and decide whether we're going to spend our money on this or that. And if you don't have some sort of framework, which we call a budget, I know it's not a popular word, that helps you align your spending with your values, then you could get in a pickle pretty fast.
And Teresa, though, I mean, it does seem like there are a lot of tools to get a better handle on your financial literacy. I mean, a lot of us grew up, our parents didn't really talk about it. As you mentioned, it could be a privacy thing, or they didn't want to burden their children. But when we do we hear all these things, these AI tools, ways to automate it. Why then is that not correlating to the results that we should be seeing here?
Because I think when you take something that's very personal and you try to use universal methods, sometimes it just gets lost in translation. There's a lot of information on the internet, not always a lot of wisdom, and your goals are unique to you. So if that tool or that software or that person you're going to is giving you just broad strokes, it may not feel like you can really apply it to your life, and you just lose motivation.
And so I want to ask you about some of the key findings, because some of it is about sort of earning the money, and some of it is about how you're spending your money as well. Talk about that dynamic.
So a lot of people think that this is an income problem, that people are struggling to live, we're living paycheck to paycheck because we don't earn enough. But what we have found in meeting rooms with clients is that it's often a spending problem, either overspending or impulse spending, as well as what we call lifestyle inflation. So I know people who are lawyers and doctors who live paycheck to paycheck, and I know people who are doing great that make less than $50,000 a year. If you build healthy habits, or you start incorporating those into your life, you'll find that the check goes further if you just manage it better.
And I want to ask you about credit scores, because a lot of people wonder, is that something they should start establishing very early on, or should it be closer to the time where they're going to need to make a major purchase and it becomes more relevant? Talk about some of the findings from your study on credit scores and how they're faring.
So a lot of people want to have good credit, but a lot of people don't understand how to build it. Credit is important if you're going to buy a home, especially with interest rates where they are right now, or buy a vehicle if you don't have cash to pay for it. But a lot of people, because they're staying on mom and dad's record, they're not building their own credit score. And we actually did a podcast on this just recently. And so what we found was there are a lot of miscommunications out there. A lot of people think that they need to carry a balance, which is not accurate. That does not build up your credit score quickly. What builds it up is consistency. Using it, paying it off consistently, and not having late bills, and this extends to medical bills. Utility companies often will share your score or report to crediting companies as well. So there are a lot of things you can do to build that, but really it's about having things that are in your name, that you're paying on time consistently, and not being stretched too thin.
And it certainly doesn't help the cost of living if you're trying to pay rent or trying to move into a new house. Yeah, you probably would be more likely to stay at home with your parents. So if there are some top tips, though, in really sort of gaining your financial independence and how to sort of work through that so that you can be less reliant on your family members, what do you recommend?
First thing I would recommend is educate yourself. Again, I mentioned there's a lot of information, not a lot of wisdom. So make sure you vet your resources, but take some time to understand what options you have to you, what things are out there. Next thing I do is align your decision-making with your values. So we've got some tips here about removing your cards from shopping websites so that you're not as likely to make those impulse purchases. Requiring a cooling off period if you tend to overspend before you buy an item. If you have access to an employer plan, it is a beautiful tool. Please, please, please contribute to get your match, and then create your budget and stick to it.
I know it's tough to do. It's one of those things where simple doesn't necessarily mean easy, but at least if people have a roadmap, they can start somewhere. A big thank you there to Teresa Arrigo, Genwealth financial advisor. Thank you so much.
Thank you.
You're very welcome. All right, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
I think the last Fed meeting, it was a bit surprising to see them hold rates steady, but indicate that they're going to be raising rates 2 more times. It's a little confusing for investors. What more do you need to see? Why are you holding? Why are you pausing? Should you just raise rates now if you're planning to do that later? So I think there's a lot of push and pull right now from the Fed that investors are trying to grapple with. And yes, I do think that's going to cause chaos in the markets and chaos from an investor perspective on which way you go. Anytime you have anything to do with interest rates and how it affects people's money, that's going to cause some chaos.
Wall Street has seen several key downgrades in the last week, most notably Tesla and Alphabet. The EV maker faced 3 big downgrades, with Morgan Stanley, Barclays and Goldman Sachs all providing a fresh take on the Elon Musk-run company. And Alphabet also got hit with an analyst call this week after UBS downgraded the tech giant. But despite these bearish calls, one thing stood out that could be confusing investors: a price target hike. Yahoo Finance's Jared Blickery joins us now to explain. Hey, Jared.
Hey, Rochelle, and maybe a little bit of a non-intuitive head scratcher here. Let's start with Tesla. And this is the analyst's entire stock history of calls on Tesla going back to just before the pandemic in 2019 there. And you can see that initial call was a hold. This purple line is Tesla's stock price, and this cyan line is the price target put in by the analyst. And you can see as the price moves higher, the cyan line, that is a price target, is moving along with it. And that is done by the analyst until we get up to this top here and we start stair-stepping down. And at that point, we also notice a stair-stepping down in the analyst target here. But something happened this year. It's been a little bit more difficult to predict. You can see they raised the price target, then they lowered it. And then we had this huge rally that most people did not expect. And we saw the mega caps really rally. Tesla was one of them. We got a huge gain in May. And so the analysts saw that. They said, we saw the pricing environment right now. I'm going to get to the note in a second. But price has finally come up significantly. And we're going to adjust our price target accordingly. Now, they have put a hold on it, so it's no longer a buy recommendation, but they're not saying sell. So if you've already bought it, sit on some profits here and just kind of wait it out. Also, they get to lock in their price target, which has been reached now. So let me go to the analyst note, and I see this as a little bit of a mea culpa here by Goldman Sachs, because most analysts really did not anticipate what was going to happen this year. And so let's take a look. We're downgrading Tesla shares to neutral from buy, as we believe the stock now better reflects our positive long-term view of the company's growth potential and competitive positioning. This is after post the substantial move higher year to date up 108%, and in the last month 38% versus the S&P's 5%. So basically prices come a little bit too far too fast, and then we're going to step back a little bit, because while the primary reason for the change in our view is that we think the market is now giving the stock market more credit for its longer term opportunities, talking about the price once again, we are also cognizant of the difficult pricing environment for new vehicles, get into some margin talk there, but regardless of how you feel about the EV opportunity here, they're saying they'd like to stand back for just a second here and kind of reassess. And we're seeing a very similar thing going on with Alphabet. So here's Tesla, there we go, Alphabet. Similarly, we have the stock price in purple here, we have the analyst target price in cyan. This analyst started out with a buy in 2019, and you can see the price target basically moving higher until price starts moving lower, then it follows the price down. And finally, we saw this surge of price up to meet the analyst target. And at that point, the analyst takes a call, the buy call off the table, and says, hold, sit on those profits there. And they do get that notched as their specific return. There is a buy down there, a hold down there, so they can just lock that in. I'm going to go to the Alphabet note, and we're going to see something very similar here. I think this kind of speaks as to the earnings season and the macro environment we're in. Difficult to play here. And here's what we're seeing. It's difficult to see our upside given the current high single-digit sites growth estimate and consensus calls for acceleration, et cetera, et cetera. They talk about the huge price run-up and also the fact that they like Meta and Amazon, so maybe go fishing somewhere else right now. But the bottom line is the call, the actual recommendation by analysts, a little bit different than the price target, and they can use both of those to send the messages as they deem appropriate to investors. Rochelle.
A fantastic breakdown there, especially for people looking at these high-tech spaces and wondering how to play it. Thanks so much. Our very own Jared Blickery. All right, well, summer travel is here, but did you know that 1 in 5 consumers go into debt just because of their vacation? 81% of consumers incur over $500 worth of debt on their summer plans. So what are the best ways to plan the trip that you want to take and continue to save? Well, that's what Accrue Savings seeks to answer for us. It's a growing fintech company that offers a new option to help consumers save while paying for their products. And joining us is the founder and CEO, Michael Hirschfield. Michael, thank you so much for joining us here. So talk about what Accrue does to really help people not have to go into debt when it comes to saving for vacations.
Well, thanks for having me on. I mean, you answered the question. In many ways, Americans have over $1 trillion in credit card debt in the United States. And with 1 in 5 Americans going into credit card debt to travel, you can see this growing threat to American personal balance sheet. And so, at Accrue, the company's a year and a half old. We just partnered with Sheepaware, one of the largest OTAs in the United States. This notion that Americans are actively saving and there needs to be an alternative path for Americans to do what they love, We love to travel as Americans. That path of saving up for a trip is so important. And this rising trend around buy now, pay later as well, that many airlines and many OTAs have taken on, continues to put pressure on American consumers because of the rising risk of credit to their own personal lives.
And are we seeing more of these airlines and these sort of holiday companies adding that feature of some sort of save now, pay later? And how is that affecting things?
Yeah, I mean, we're the first of its kind in the world to offer something like this. So over the last 5-6 years, you've seen a growing trend around buy now, pay later, which is obviously the debt short-term consumer credit debt installment plan. And Accrue is a very different vision that saving, the active saving by American consumers should be offered. And so what we introduced our first partner, which was Cheapo Air, one of the largest OTAs in the United States, to give consumers that choice. What's interesting, we've seen in our research, 25% of Americans right now are actively saving for travel. And historically, they've never been incentivized to do that. I mean, the counter action is being taken by so many airline and OTAs, and frankly, all retailers, not just in the travel category, by trying to get consumers to use credit, maybe use money they don't have. And because Americans are actively doing a behavior which is saving, there's an opportunity. There's an opportunity for that sensitivity that brands and airlines can have to give them the opportunity to engage with consumers, to save with them in a way that's inspiring before they make the purchase, before they're ready to buy right now. And that's the hope, and that's the opportunity, and why we've grown so quickly in such a fast fashion. And I also want to talk about travel in general, right? If only 8% of Americans are using points, and the beautiful statistic you have right now are using points, that means the majority of Americans need to use their own money to make a purchase. And so we have to be very careful as Americans to make sure we're spending money that we have, not spending money we don't have. Because as the rising $1 trillion credit card crisis comes and hits, we need to make sure that we're in the right place.
And that's interesting because a lot of people, they'll gravitate towards a credit card because they're like, look, I can get the points to spend on travel. Do you think then that sort of way of paying for trips will die out as companies like yours are able to get perhaps more customers?
Oh, we believe so. And actually, what's trend line interesting from millennials and Gen Zs is there's tremendous insecurity and headwinds, particularly around credit. But the thing that millennials are more scared of in their life is credit card debt. The statistics and the data continues to show that credit card debt is a great fear, the number one fear for millennials. And Gen Zers are the ones that are jumping onto the debit card usage. And so there's this growing trend of the American consumer, the young consumer, of using alternative paths, payment diversity to engage with airlines, OTAs, hotels, et cetera. And so companies like us, Accrue, as we expand and partner with airlines and partner with OTAs and partner with hotel brands to offer that choice, we think that will be another path for them. Your generations change how they spend their money, and the credit cards of my parents and generations after that is obviously being incredibly impactful. And it's not necessarily negative, but there are other ways. And American consumers of the millennial generation and Gen Zers, they want another way. They saw the debt crisis, both that it impacted people in their lives, and they want to necessarily do something different. And obviously, we're seeing a rising credit card delinquency rate in the United States with short-term consumer credit in buy now, pay later, and in credit cards. And that's the behaviors that we're going to see major change in the next few years to come.
And certainly demand, at least for travel, not slowing down anytime soon. What are some of the top tips then so that people can try and save on their travel plans, especially if they're able to do it a little bit earlier, not last minute?
Well, I think, you have to be thoughtful about it. Last minute travel is obviously very, very expensive. So first thing is around behaviors. Create a budget, start to save. Be aware of the pricing fluctuation that exists in the travel market. Clearly, if you are aware of the huge ranges the pricing may take, you will make a decision at the right time to buy the trip. Also, choose the right time to go. Summertime travel is particularly expensive, so you can push off your travel to other times of the year, which is less expensive. You're going to be more conscious about the budget that you're going to do, and also bundling hotel and travel. A lot of airlines, a lot of OTAs have that opportunity, and that you're going to see a significant reduction of your costs if you're able to do that. It's about thoughtfulness how you spend your money. Obviously, be careful how you use your credit, and budget and use the money you have, because ultimately the darkness of credit rears its ugly head, and it's important to make sure you're spending within your means.
And Michael, of course, just quickly, you mentioned Cheapaware there. Talk about that partnership, and are there any other companies that you're targeting in terms of who you'd like to partner with?
Yeah, it's amazing to partner with Cheapaware, one of the largest OTAs in the United States. They've identified this opportunity that 25% of Americans are actively saving right now for a trip. What an opportunity to engage in a relationship much before our user is ready to make the purchase. So we launched with them, and consumers get 6% in cash rewards to save up. It's that dopamine, that power of wow. That wow when I'm saving, that reward to save, and ultimately I get the money that I need to buy the purchase. You go and you purchase on Cheapaware for 6% less because you've done that really great behavior to save up for it. And obviously in the next few months, we'll launch with other airlines and other OTAs, hotel brands. This is a moment in time in the US economy that Americans realize that they need to use their budget wisely. There's growing, obviously, risk around recession. There's a white collar, obviously there's tremendous job loss with white collar workers. The idea that you have to be more conscious around your budget is really important. And airlines and OTAs are becoming more aware of it. And a company like us, obviously we've been around for a little under 2 years. The idea that this notion of saving engagement, saving interaction with OTAs is the future, and we're the only player in the category, and really appreciate all of our investors and obviously Cheapaware to be the first major OTA to partner with us. More to come, I promise you, in the next few months and years.
Well, we'll definitely have to have you back on to discuss that when you take on more partnerships. I know consumers happy to try and save on their travel. A big thank you. We'll have to leave it there. Accrue Savings founder and CEO, Michael Hirschfield. Thank you so much.
Thank you so much.
All right, well, if you travel, you might want a little wine. Wine Spectator came out with its 2023 award list, celebrating more than 3,000 restaurants that have innovated the hospitality space. But behind the scenes, innovative tech is helping restaurants elevate the customer experience while improving operations and profitability. Craftable is a technology platform that assists companies in the hospitality sector to manage their staff, inventory, sales, and anything else you can think of that goes on in the back of the house. Now, the changes in the restaurant industry are just one area that they're focused on. For more on this, let's bring in Craftable Senior Director of Restaurant Success, Russ Spencer, to discuss more. Thank you for joining us this morning, Russ. So as we've seen that obviously people still want to go out to eat, but as they tighten their purse strings, what do restaurants need to do then in terms of the customer experience to really keep them spending?
Wow, thank you for having me. I look forward to having this conversation. So we've seen a shift in business. So I think sales are coming back to a pre-COVID environment. So it's really that it's shifted. So now we're starting to understand how customers are migrating to different times of the day or different segments within the business. So maybe more carry out or family meals. And so I think it's really imperative for our restaurants to really understand the behavior of their customers and how to maximize their profits with those customers.
I mean, I've noticed that, when I go out to a restaurant, some of the customer service isn't quite what it was pre-pandemic. I think people are stretched quite thin. What should some of these companies and restaurants be aware of when they're thinking of the front of the house and people who are going to be that front-facing person direct to the consumer?
Well, it's funny. I think most people remember how they feel more than they taste, right? So it's all about creating that emotional connection with the customer and creating the memories together. And what we're finding is the consumer today, so Gen Z, primarily, and the millennials, are more related to a brand and a story and a connection with that customer. And while the cost of goods have gone up and inflation's taken a big impact on our industry, it is very interesting to watch customers continue to funnel back into their favorite restaurants and repeat and increase frequency. And again, it's all based off of that emotional connection they have. We just got to learn how to make money off of them. As inflation's gone up, it's been a struggle for all of us.
Indeed. And I mean, a lot of, restaurants are struggling with, should I pay for, an Uber Eats or Deliveroo or some kind of company to do that as another cost? Plus, when you factor in labor costs as well, what are some of the tech innovations that restaurants should be honing in on to really help profitability but keep the flow of business coming?
Yeah, absolutely. And there's really two ways to support that. So I always look at, we want to change the customer behavior, right? So we want to encourage them to order when we want them to order and order what we want them to order. But at the same time, we need to be able to manage our own behaviors, which is really focused on reducing the waste within our business. It said about 4 to 10% of purchases that walk through the back door are wasted before they ever even hit the plate. So how can we use tech to identify the opportunities, mark the spot within the business to drill down into those opportunities and reduce that waste? At the same time, continuing to encourage the customers to come in when we want them to come in and order what we want them to order, which is what drives most profit to the bottom line. And it's almost impossible to do that if you don't have a pulse on every purchase coming through the back door and every sale going out the front door and being able to monitor that.
And that's one of the roles that a lot of people are hoping for with AI, sort of to better track what's in demand, what to order, especially when people do have the option to, buy their groceries and spend money at home. When you look at the options that people have from buying their own food versus and thinking about inflation versus the inflation that they pay at restaurants, where are we now in that balance?
People are still eating out. I mean, they're going out for the connection and they don't mind spending the money. But again, I think the value has to be there. And value isn't always measured by how much it costs. It's measured, did you get what you thought you were paying for? So it's all about that connection with the experience. And I think when customers create that connection, they're willing to spend that money and funnel back into our restaurants.
So then as we broaden it out to sort of hospitality tech, what do you think is going to be some of the key themes that you're going to be keeping an eye on?
I think really it's about keeping a pulse on your business. If you migrate back, let's just say 10, 15 years ago, we relied on sales to make money. And so the money was in the business just by pushing sales through the front door and cash flow and 10% to the bottom line. Where we've seen inflation increase by as much as 7 to 10% in cost of goods and labor, all of a sudden we're struggling to really drive profit. So it's about keeping a pulse on your business and understanding where those cost of goods are, when your customers are coming in. What are your customers ordering? I always like to jokingly say, if I go to a concept, let's just say like Panera Bread, and I don't visit them for 2 or 3 weeks, they remind me to come back by using their artificial intelligence to track my purchases and how often I've been in. What do I order? So it's really about understanding your customers and how often they come in, what are they ordering, and then again, monitoring and measuring that profit from the back door all the way through the front door.
And Russ, I want to ask you about AI sort of as either a co-pilot or sort of supporting some of these restaurants, because anytime we talk about AI, you think about streamlining and job losses. You're seeing a lot more companies sort of having these big monitors. You can sort of order directly while you're in the restaurant. What are you seeing in terms of either the threat or how you see AI really shaping the future of the labor market when it comes to restaurants?
Well, the number one challenge every restaurant struggles with is staffing. So I think it's beneficial to our businesses to really embrace that AI and bring it into their business. And how can they increase efficiency and increase speeds within their operations and reduce, turnover within their staff. And, the number one challenge every restaurant has, again, is staffing. And the best way to resolve staffing is not need staff, right? So if we can replace some of the staff with AI and then be more efficient with the staff that we have, then we don't have that need anymore. And again, it's not that we're looking to replace as much as we just don't have the staff out there to be able to employ the restaurants. As we've seen sales increase, many of the operators are not able to operate at full capacity just because they're not staffed.
Indeed. Well, a big thank you for joining me this morning. Craftable Senior Director of Restaurant Success, Russ Spencer. Thank you for your time.
Thank you.
You're very welcome. Well, the US is considering new restrictions on AI chip shipments to China. That's according to reporting from the Wall Street Journal. The news sending chip stocks lower today as concerns continue to mount over the possible threat of advanced AI in the hands of US rivals. Jill Malandrino, Nasdaq's global markets reporter, joins us from the Nasdaq to break it all down for us. Hi, Jillian.
Hi, good morning, Rochelle. Semiconductor stocks were hit following reports that the Biden administration is considering new export curbs on AI semiconductor exports to China. The Wall Street Journal reported late Tuesday that the Commerce Department is mulling new restrictions that would halt shipments of AI chips made by Nvidia as well as AMD and other companies to Beijing starting as early as July. Any ban on China-bound exports would both clip a significant amount of sales from both Nvidia and AMD, but also leave each company as well as their U.S.-based peers open to retaliation from Beijing as it continues to challenge Washington efforts to influence its trade and economic policies. Semis have been the leading sector, and Nvidia has been the leader in this move related to AI, with shares up over 180%. Year to date. According to Morgan Stanley Research, tech generally has the highest foreign revenue exposure, with 56% of revenues coming from abroad. Semiconductors is partially responsible for the sector's high exposure, with 28% of its revenue coming from China and 30% from Asia, ex-Japan and ex-China. Morgan Stanley believes these numbers may be artificially high relative to end demand, as semis bought in these regions are used to make electronics sold in other regions, with many of the finished products ending up in the U.S. and Europe. Note that Nvidia has the highest exposure to China, with 45% of its revenue derived from China.
And that is why we're seeing it under pressure today. But I mean, still, Jill, investors extremely bullish on Nvidia. Do you think sentiment will continue for the second half of 2023?
Well, AI systems need to process massive amounts of data quickly. While the performance of general purpose chips is improved enough to kickstart a new generation of AI technology, they can't keep up with the exponential increase in the volume of data that AI systems process. Nvidia has dominated the GPU market for years, and its chips portfolio is being built for accelerating AI. In fact, the most important and widely used AI chip in the world today is Nvidia's A100 GPU, and its chips already fuel the tech behind OpenAI's ChatGPT and Alphabet's Bard chatbots. Recall, Nvidia crushed earnings this past quarter, and management's outlook for both top and bottom line blew away analyst expectations for the next quarter, sending the valuation to over $1 trillion. Now, the street is still running through models following the Wall Street Journal article, but consensus suggests Nvidia could potentially see 10 to 15% impact to revenue. Of course, the Commerce Department has not verified anything from the Wall Street Journal report yet. So it's just analysts are going through their models to determine what it could potentially impact the revenue.
And staying on that beat, of course, Jill, Micron reporting after the bell today. What are analysts expecting for the chip maker?
Yeah, interesting. Micron is actually one of the most heavily traded stocks in the Nasdaq 100, so we pay attention to this one. The improved prospects for memory chips have given a rebound to Micron, which has risen some 14% over the past 3 months, compared to the sector median increase of about 7%. Not only has the stock risen 34% in the past 6 months, the shares are up about 32.5% year to date, give or take. Citi analysts still believe Micron fundamentals are driven by the DRAM cycle and expect a DRAM recovery in the second half of 2023, driven by undersupply, regardless of the China ban, and analysts reiterate their buy and price target of $75 on Micron. The company has benefited not only from improved prospects in the memory chip business, but also from the excitement from generative AI, which could help to bolster its earnings recovery. It's important to note that Micron's memory chip business is highly cyclical. Aside from weak memory chip demand and falling prices, the company has also dealt with supply chain headwinds in a memory market which were already highly volatile to match the fluctuations with demand. The memory supply chain is expected to bottom out in the second half of 2023, which could potentially lead into a cyclical recovery in early 2024. And this explains why the stock has done so well in recent months. It will continue to do so, assuming a top and bottom line beat on Wednesday today after the close, along with positive Q4 guidance.
And we were waiting for that heavy hitter to come out against Nvidia, a rival here. AMD, of course, recently unveiled its own set of chips to compete with Nvidia. Shares soaring on that news, but can investors expect more gains in the second half of the year?
Well, of course, AMD is trading in sympathy with the semiconductor space. It was down about 4% in the pre-market, but we've seen it recover since then. The company recently unveiled its own set of AI chips to compete with Nvidia, to your point, the most complex chips that AMD has ever made. In fact, in an interview with Yahoo's Brian Sazi with AMD's CEO, Dr. Lisa Su, she called AI the defining megatrend in technology. Just AI chips in the data center is a market that Su expects about $30 billion in revenue this year to about $150 billion in the next 3 to 4 years. That's a 50% increase year over year. The stock performance will be tied to the market's expectations of AMD's execution prowess in the second half of 2024 on whether the company could gain a more solid foothold in the AI chips market. That's really what the performance is going to be predicated on.
You know, a lot of people focusing on that AI execution and what that means for chips. Great stuff there. Thank you so much, Jill Malandrino, there for us. All right, taking a look at sales of Bud Light. They continue to take a hit for the 11th week in a row. Now, its parent company, Anheuser-Busch, is out with a new marketing campaign. Brooke De Palma is here with the details. So, Brooke, break down for us what sort of impact we're seeing on the company now.
Yeah, good morning, Rochelle. I mean, this is the third straight month of declines following that partnership with trans influencer and TikTok personality Dylan Mulvaney. Of course, U.S. CEO Brendan Whitworth continuing to emphasize that it was one can and one gift. But the week ending June 17th, sales of Bud Light declined 28.5%. According to recent data, that's an acceleration from the week before of down 26.8%. We also know that Bud Light recently lost the top spot in the U.S. beer market to Constellation Brands. It's also feeling the impact across its portfolio. During that week ending June 17th, Bud Light volumes down 31.1%. Michelob Ultra, Busch Light, as well as Budweiser volumes also down. Of course, those are all under the Anheuser-Busch umbrella. But Evercore ISI saying in a note that this continued weakness begs the question of whether Anheuser-Busch or its distributors will have to make structural changes to reduce their cost basis if these trends don't improve over the next few months. That is, as you can see here, shares of Anheuser-Busch down over the last 3 months. Since this started back in April, it's down more than 15%. But its competitors, Molson Coors, as well as Constellation Brands, once again, that's behind Modelo, who now has the top spot, are up, both higher over the last 3 months. We know that Constellation Brands is set to report its earnings this Friday, and so certainly we'll be tuning in to see if this is mentioned in the call.
And Brooke, in terms of next moves, now the company trying to move forward from this sales decline with a new ad campaign. So break down what that does.
Yeah, well, that's right. The company is out with a new ad campaign, and we know that the company is investing heavily to get this story back on track. This ad you see right here is part of a larger campaign called That's Who We Are. This first ad in particular is called We Make the Beer. It includes a 30-second and 60-second spot that's set to debut in local markets, and it features 140 Anheuser-Busch employees, growers, wholesalers, as well as partners. Of course, Rochelle, those are the ones that have felt the brunt of this sales impact directly. We know that many of those people on the front line have received harassment, have received threats following this boycott, following that Instagram post. And so now the company is heavily investing in those frontline employees, as well as providing financial support to wholesale retailers. But they're not alone in this culture wars. As you can see right here, other companies have gone and swept in, including Target, Starbucks, as well as Disney. And so this is just one of the first moves as Anheuser-Busch looks to get this story back on track, looks to get control of this sales decline. And ultimately, we'll see where it goes from here as it looks to move forward as a beer company.
Indeed, we'll be keeping a track of that. Thank you for that update. Brooke DePalma there for us. Thanks so much. All right. Well, before we go, let's get you a final check of the markets as we head into the noon hour. Still looking at a mixed picture here, though, as we see the Dow well off its session lows. They're down about 1/3% or 88 points. The S&P 500 also still barely in the green there, just barely, up by about a point. That's being driven by consumer discretionary and energy sectors. Taking a look at the tech-heavy Nasdaq there, also up about 60 points or about 0.4% there. And we're seeing still some chip makers under pressure with a bit of a drag there, but tech still rallying ahead, except for Nvidia. Well, that does it for now. I'm Rochelle Akufa. I'll be back with you at 11 a.m. Eastern tomorrow. Until then, take care.